you don't want to miss.
The fact that you can have a central bank that pauses for month after month after month after month and then comes back with a hike, which is what the RBA did. S&P futures then, they are down 0.3%. So that earlier point about how that negative sentiment for risk assets is expected to run. And because we're talking a lot about supply, it's not all at the 30-year horizon, but I put the 30-year in here anyway to remind us where we are on that yield story, as those yields are going higher, 4.82%. Lots of supply coming, a 3-year auction. We've also got a lot of corporate debt. And so talking about supply is going to be something we continue to do. This is the futures picture for Europe then. We looked at what was going on in the US, negativity there, negativity through the Asia session, and some of that here in Europe as well. DAX, FTSE and CAC futures all expected to be weaker. The CAC futures actually down by 0.5%. So we'll see if we get that level of underperformance coming through in the French market. So the FTSE 100 is open, down around 0.1% at the early stage of the trading day, worsening just a little. We do see some risk-off sentiment in the FX market as well. You'll see the Bloomberg Dollar Index is getting a bid this morning, up by 0.3%. The pound and the euro both down by around 0.2%. And here's an interesting development in sovereign bond markets. We're seeing selling here, yields going higher. We saw yields going higher around this time yesterday, as if the market here in Europe, not quite sure of this theme that we had inherited from the US labour market report on Friday around lower yields, and we've been questioning that here in Europe. So we do see these yields going a little bit higher, but the German 2-year, the French 2-year, you can see all picking up on that theme. Having said that, the UK market looks a little different. We see yields going lower as gilt markets just open up, but they are just opening. Back to the equities then, and we do see that underperformance then in the French market. The CAC 40 down by 0.6%. Italy, the FTSE 100 in London, the Spanish IBEX all down by 0.3%. Let's have a look at the sector breakdown then and see if we've got weakness in consumer goods. Sometimes it explains that French underperformance. So we'll see what we've got coming in here. We've got consumer stocks. They are negative, but just down by 0.3%. Energy names also could be an explainer, down by just over 1% on the energy stocks this morning. Travel and leisure, autos also weaker. So plenty of sectors in negative territory, but nothing hugely standing out as the overall driver of sentiment. This is the overall picture, though, down by 0.3%, down by 0.5% on the French CAC 40. Let's talk about what's happening in these markets then. Paul Dobson joins us from our MLI team. Paul, nice to have you with us on the programme. Let's talk US monetary policy, because it does seem with the selling of risk assets we've seen through the Asia session and into Europe and in US futures, it does seem as if we're questioning the idea that the Fed is done. And we've seen a bit of pushback from the likes of Neil Kashkari around whether the Fed is definitely done and whether the fight against inflation is done. So what do you make of the latest musings we're getting from the Fed?
Yeah, well, I think the market is caught between these two sort of different arguments at the moment, Anna, that's making it very difficult, because the Fed has started to talk up the idea that the higher interest rates are doing some of the tightening for them, which means they may not have to raise interest rates as far. But then the market interprets that as, well, the Fed is less hawkish, maybe yields should be lower, pushes them back down. That loosens the financial conditions, and then the Fed has to talk them back up again if it wants to have any impact. Now Kashkari has been one of the more hawkish members of the Monetary Policy Committee for a while, but I think in general the Fed wants this two-way risk in the market, doesn't want the market to believe the rates are definitely going to go down from here, that it's definitely now peaked and going to cut. It wants the door to be left open for further hikes. So it doesn't have to do something like the RBA did today, which is reopen things after a little bit, but only for a sort of one and done, okay, kind of like let's get the message out there that we can still hike, but not sound very convincing about it. And so, that's the kind of message the Fed is trying to convey. What we're seeing in the yields as a result is pretty big swings backwards and forwards. People are trying to suss out this monetary policy, keep an eye on the eco data, keep an eye on the fact we've got lots more Fed speakers, including Powell, coming up this week as well, still to watch out for.
Yeah, absolutely. So we'll see if we get more sentiment from the Fed that indicates, yes, they do like this two-way risk. And as you point out, lots of volatility in fixed income markets as a result. Another thing creating a lot of volatility for treasuries in particular is bond supply. We see a focus on treasury supply this week. We also see a focus on a lot of corporates raising money, and so more supply on that side of things as well. How does that all stack up for you?
Yeah, so that's the other side of the coin at the moment. We've got the monetary policy dilemma. We've also got the fiscal policy dilemma and debate and argument about it at the same time, right? So much bond supply coming to the market. We had the quarterly refunding announcements last week that the market took to be, kind of a little bit less on the supply side than might have been feared, and good news, and yet it's another sort of thing where the US government holds back a bit and all the corporates come flying through the door. This is a great time for us to, raise interest rates if we think that the 5% levels are going to be attainable again on the 10-year. We want to do it before it gets back up to those levels. Here in Asia, we had Indonesia jumping on the bandwagon, announcing 5-year, 10-year dollar sukuks today. So right around the world, there's that sense that there's a window here. Now, it's not like there's no demand for that at all. You have the likes of Double Line, one of the big bond funds over in the US, saying that it's getting long blue chip corporate debt at the moment. It likes the look of these yields. It senses there's an opportunity there. Not worried about the spreads, not worried that the economy is going to crash, just enjoying the yield pickup that it's able to get and the overall juicier yields that it has. So there is some hope there on the supply side, on the demand side as well. And yet again, it's just that kind of trade-off, that back and forth between those two sides, and the sort of swinging to one side of the boat or the other, depending on the day and the time of the week when whether yields are up or not at the moment, making it very uncertain and difficult for traders to time, and these investors and salesmen to time too.
So adding to that idea that the Fed likes two-way risk in these markets then, Paul, you also have the added sort of geographical complication, that dimension on top. And I mean, just in the last few trading days, the bond market in Europe hasn't looked identical, and why should it, to what's going on in the US, as if there are a few different narratives. What does all of this mean then for the rest of the world?
Yeah, well, I mean, from an Asia perspective, it feels like the day starts sometime around mid-morning in Europe at the moment. So we seem to be at the end of yesterday's story, not the news story for the day. And that's because there's so much central kind of thinking around what happens to the US interest rates and what happens to the dollar. That really being the conduit that's setting the risk tone for the rest of the world at the moment. Yesterday, we had an outstanding day for Asia's currencies, which all went flying higher. They've been right up against the ropes for weeks and weeks. Central banks doing everything to resist the stronger dollar. When that seemed like it was coming away again with the lower yields, the weaker dollar. Yesterday, we had a real boom back. But today, we've had another reset, with the dollars back up, the Asian currencies are weaker again and looking vulnerable and susceptible. So I think that's the mechanism through which those bond yields and then the US dollar transmits into the rest of the global trading structure. And, we're at the end of the story here at Asia each day. So Monday morning is always going to be fraught and exciting for us for the next few weeks, it would seem.
Yeah, your Monday looked a little like our Friday, for sure. Paul, thank you very much. Bloomberg's Paul Dobson joining us there with the latest on these global markets. Let's home in on the banking sector here in Europe. UBS shares are trading higher this morning. Despite reporting its first quarterly loss in almost 6 years, UBS says it has now stabilised its former rival Credit Suisse, but it's warned investors to expect another $1 billion of integration costs in the fourth quarter. Let's go to Bloomberg's Guy Johnson, who joins us now from Zurich. Guy, good morning to you. So there's concern on the one hand around costs and some of the integration costs to come, but somebody's pleased enough around costs because lower than expected costs, one of the reasons being cited for the shares going higher today. What do we make of the fact that the stock is going higher this morning?
I think the situation could have been worse. It's a bit of a lottery, to be honest, with what is happening here. It's very sort of subjective, touchy-feely in trying to understand what's going on. This is the first full quarter of the integration. There are no comparisons. We're trying to get a sense of what is going on. It's not an exact science by any stretch of the imagination. The costs broadly probably look better than anticipated, but the anticipated numbers all over the place. Nobody's really got a handle on what is happening here. The steer from UBS looks okay. They've stabilized Credit Suisse in terms of the wealth side of the business. That's good news. They're clearly trying to retain staff. That goes into some of that cost story that you were talking about. But costs broadly don't look as bad as expected. Another critical thing as well is they've stuck to some of their 2026 targets, which they laid out kind of very early on in this process. And there was some sense, certainly from the analysts that I've been talking to over the last few days, that maybe those 2026 targets were ambitious. They've stuck to them. That's a pretty good sign. There are also signs that they're going to be able to accelerate certain sort of parts of this integration process as well. So broadly, things look on track. And I think that's really all the market wanted at this point, Anna, was a sign that things are on track. And I think from that point of view, there's a tick in the box.
Yeah, absolutely. And some positive lines coming through around the stabilisation of the Credit Suisse, the former Credit Suisse business, saying that deposits at Credit Suisse have been stabilised, and also stabilisation in new money statistics around that part of the business. So that seems to be comforting. I suppose looking ahead, though, are they on an ongoing basis able to retain the right people, the people that they need to stay with this business during a period of huge flux?
Well, you look at the cost line. There is 500 million, I think, in there for that purpose, to make sure that they do retain the right people. So they're already kind of allowing for the fact that that process is going to cost money, and it's going to come down to what these people are paid to go through the uncertainty that now exists. This is an unbelievably messy process that they're going through. It's very difficult. You don't see this kind of transaction on this kind of a scale very often. So yeah, they're going to need to retain people. They're going to need to retain the right people, and they're probably going to have to pay them through this period of uncertainty. We're going to learn more, Anna. Up next is the full year numbers. Up next is the big strategy update. That's really what the market is now looking for. This was a bridge set of numbers, but the indications are that they're kind of on track for where the market broadly thought they would be at this point. But it's very messy. These are very messy sets of numbers. There are many areas in which this integration can trip up on. It hasn't happened yet. Doesn't mean it won't happen.
Yeah, and interesting, as you point out, that they are able to commit to some of those early estimates. The more they look under the hood, they stay intact. That does seem like a positive. Guy, thank you very much for the update. Bloomberg's Guy Johnson, live for us in Zurich. Coming up on the programme, watches of Switzerland Group. Shares jumping there after the luxury watch retailer reaffirms full-year guidance. We'll be speaking to the CEO, Brian Duffy. Talks to us next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Markets Today. We are 14 minutes into our European trading session, and European equity markets a little negative this morning, perhaps not quite as much as we had feared, but down by around, less than 1/10% on the overall Stoxx 600. A little positivity actually coming through from the IBEX and the FTSE MIB. So at the margins, that's meaning that the losses are limited. The French market, the DAX, also in Germany, both of those down 0.2%. Let's talk about a stock that's moving higher this morning, though. Watches of Switzerland Group shares jumping in trading this morning after the luxury watch retailer reaffirmed its full-year guidance. Following those earnings, HSBC raised the company from hold to buy. Let's talk to the CEO of Watches of Switzerland. Brian Duffy joins us in conversation this morning. Brian, nice to have you with me on the programme. Let me get straight to it. You've confirmed your guidance, but a lot of people watching the market were concerned about recent news from Rolex about the changes in the way that Rolex operates in the market. So I wonder, in the context of that Rolex news, how you're able to confirm the guidance. Give us the sort of backstory there.
The backstory is that Rolex acquired a Swiss retail group because they were concerned about continuity of ownership without any succession. So they did, I think, what was a very elegant thing and just acquired the group. Rolex make a lot of investments that they handle, as investments, hands off, and they've been completely clear and reassuring us that's the intention here. We're not going to get involved operationally. And when nothing changes, I've had that reassurance. I've been able to confirm it to the market. So it's not something that affects our business model or plans at all. We're confirming that that's the case again. We've actually got the biggest and longest list of projects that we're doing with Rolex over the next 2, 3, 4 years. So it's been a bit of a non-issue and an overreaction of the market. Yeah.
Okay, we did see a big reaction, didn't we? And Brian, you're setting us straight on that today. So just to linger on it for a moment, you say no change then, because a lot of people were concerned that perhaps if they bought Boucherer, that they would be selling more watches through them and less through you. But you can confirm you've had guidance that tells you nothing changes in terms of the allocation of Rolex watches you get.
Yes, I confirm. Yep.
You can. Okay, well, that's interesting. That's interesting news. Talking about consumers and their appetite for luxury watches at the moment, are you seeing any changes in appetite, in waiting lists for luxury watches at this point? We're always looking for clues as to whether there are any cracks.
Yeah, no, honestly, there's no change. More than half of our business we sell to clients on what we call the registration of interest lists. Those lists continue to grow, actually, and conversion of the lists when we contact the clients is very good. So we're really seeing no change. As we've said before, we're not immune to kind of consumer confidence with some of our business categories, like jewellery, for example. But Most of our business is the watch business, and we're seeing a continuation of healthy demand. The US market's particularly strong for us. The market's underdeveloped, which I think is accepted, and I think we're proving. Our model's working, we're gaining market share, so, you know, things carry on positively overall.
You talk about the waiting list, and you suggest that there's nothing changed there as well. Just to dissect that a little bit, sometimes we talk about waiting lists at the higher end, you know, Rolex and Patek, but I wonder what you're seeing on other brands. Are you also seeing on other brands that there's no change in the sort of dynamics of the waiting list?
Well, I mean, the other brands are, you know, less impacted by waiting lists, but overall, we represent the best brands in the world: Omega, Cartier, Breitling, TAG Heuer, Tudor, in addition to Rolex, Patek, and Audemars. Some slight changes in market demand. I think in a positive note, there's a lot of interest in, you know, the smaller, more independent brands. Again, particularly in the US, where you get a lot of innovation and, you know, a lot of difference. But the world of watches, you know, the fundamental is there's just not enough watches, Swiss watches in the world. Demand exceeds supply. And, you know, the big trends overall, you know, remain very strong.
Okay, so there's just not enough Swiss watches to go around, which is an interesting dynamic, a nice one for you. Thinking about Chinese consumers in Europe, Brian, and when we've talked in the past, you've made the point that you don't think tourism spending will fully recover in the UK because of some of the changes we saw to the tax-free shopping regime, or the removal of it. We have an autumn statement coming up, not too far in the distant future, Brian. Any sense that we'll see any change there?
My sense is you won't see change. I don't fully understand why we, you know, haven't been able to have a full study and investigation of this matter. There's no question the UK is losing out significantly. I mean, our business today is 96% domestic. You go back to 2019, we were around 30% international. So it's been a huge change. We've managed to pivot towards the domestic markets happily, but not every brand has. But the UK is losing out significantly. Studies have been done to say that GDP has suffered directly because of independent studies. So I don't quite figure why the government won't engage more in analysing and understanding this. And we think it's inevitable that it will change back because the evidence is compelling, but I don't really sense that's likely to happen in the short term. And the long-range plan that we did today, we've not assumed that that will change in that time frame.
Okay, you've not assumed any change there. You've also suggested that you're fairly unhappy with the sort of shopping environment in the West End of London. I know this is only one part of your business, but at the same time, you're ramping up, like many other people, on the digital sales side of things. How much do you think that digital can do in a business for such high-cost items such as watches?
No, we do very well online, and you know, one of the things that we've included in our plan, we doubled our online business, you know, during lockdown, not surprisingly, along with others. But we held on to all of those gains, and we lead the market online. And consumers, when they know products, and very often consumers will do the research online and shop in store, or vice versa. And we're pretty agnostic about where the consumer shops at the end of the day. We don't sell our biggest brand products online, Rolex, but of all of the other brands that we sell, online is very healthy. But stores are fundamental. People should and do, you know, try on product, take advice directly in store, and I think we'll continue to do that for the indefinite future. So stores are very important. We are concerned about Oxford Street. I think it has definitely suffered significantly over the last few years. Hope to see changes coming there, but the West End generally is still, you know, a great place to shop. Bond Street's great. We have a huge store opening in Bond Street. We'll be the biggest Rolex flagship in Europe. We'll open about a year from now, next October. So we love Bond Street. We love Regent Street. Knightsbridge is coming up, and you know, Oxford Street is a bit of a problem.
Okay, thanks so much, Brian, for your time this morning. Brian Duffy, the CEO of Watches of Switzerland Group. Coming up on the programme, we'll get back to the stocks that are on the move, including UBS. We'll break down the numbers after the Swiss bank made its first quarterly loss in almost 6 years. Sergio Amotti saying he's confident that 2026 targets are achievable. He's on track to deliver on the plan. We'll get more on UBS in a moment. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Markets Today, 25 almost minutes into the European trading day. A mixed picture, things are brightening just slightly at the margins. Let's get the individual stocks on the move, though. Joe Easton has a rundown for us, Joe.
So UBS now up around 4% over in Zurich. It did actually tick very slightly lower just after the open of trading, but now, as I say, up around 4.3%. JP Morgan writing in a note that the company's integration with Credit Suisse is going in the right direction. Deutsche Bank also has some positive commentary on the cost outlook there. Amadeus is an interesting one. This is a read on the travel sector. Always reminds me of the film about Mozart, but it's not related to that. It is a travel company that does bookings for companies like EasyJet, reporting strong numbers, potentially adding to that positivity. Yesterday we saw from Ryanair. Then we've got RS Group. This is a London maker of components that go into DIY, that kind of thing. Slammed at the open, but coming up now, down 6%. Daimler Truck has some weak sales updates from them. That's a pretty negative read. We're going to flip over and have a look. Quite a lot to get through at the moment. ABF, this is the owner of Primark, of course. Some strong sales numbers, costs coming down, helping the profit outlook there. Persimmon in the home builder space, we had that sales update. 5-week sales are improving over at Persimmon, adding to some positivity from those numbers from Halifax earlier today. Watches of Switzerland, really interesting to hear the CEO speaking there about the Rolex element. Meanwhile, Demont in hearing aids getting slammed. That one, some weak sales from them, hitting the whole sector today. Finally, just a quick look over here. Cinch, the biggest gainer on the stock 600, 20% for them. That is a technology and communications company that did well during the pandemic and is coming off a low base. Mining stocks downgraded over at HSBC. They say that stock is overbought, and a couple of other banks on the screen there.
Joe, thanks so much. Joe Easton from our equities team with the latest on those movers. Coming up, JP Morgan's Marko Kalanovic doesn't see a sustained rally in equities. We look at the US market against the backdrop of higher for longer interest rates. This is Bloomberg.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. UBS shares rise despite the Swiss lender posting its first quarterly loss in almost 6 years as the ongoing integration of Credit Suisse drags on performance. China's trade data offers a mixed picture for the economy's outlook as an unexpected pickup in imports is offset by weak demand for exports. Plus, Aramco maintains its payout to the Saudi government and investors at more than $29 billion, despite third quarter net income dropping by almost a quarter. Welcome back, everybody. Let's have a quick look at these markets. And pretty flat, actually, but maybe that's better than we'd anticipated when we saw the futures picture half an hour or so ago. We do see some weakness on the DAX, down 0.2%. The CAC 40 also down about 0.25%. The FTSE a little more resilient. And so the Stock 600 going nowhere overall, really, just down 0.1% or so. Let's have a look at the sectors and see where we are on that story. We've had quite a lot of earnings reports out this morning, certainly from the banking sector. We've heard from UBS, of course. It's a mixed picture, though, on sectors, isn't it? We've got retail going higher by around 0.9%. We've got technology up by 0.7%. The banking sector up 0.1%, but it is pretty mixed overall. I can see energy as one of the worst performers, down by 1.3%, as we see the oil price weaker by 1.6%, $83 a barrel on Brent. Let's talk about where we go on stocks. JP Morgan's Marko Kolanovic says US equities will soon be unattractive to investors again. He adds in a note that falling bond yields and dovish central bank meetings are knee-jerk positives for equities for the short term, but he questions the long-term impulse. Stephanie Niven, portfolio manager at 91, joins us on set this morning. Good morning to you, Stephanie. Let's start with that thought then. So JP Morgan talking about how, yeah, sure, we understand why in the short term stocks responded to the payrolls report last week as bad news is good news for risk assets, but suggesting that investors might not find much comfort in that thought process for very long. So where do we go when we start to be more worried about the actual US economy?
Sure, and I think that concerning outlook has very much been prominent in the earnings season we've seen so far. You know, we're thick through those numbers, and we've seen a lot of companies be really quite punished where they haven't met expectations and where they've guided weaker. And I think, you know, stock pickers will begin to really focus in on that guidance, looking out through a volatile end of the year and into 2024. And we expect to see a bit of a move away, perhaps, from that magnificent seven that's really driven markets this year. You know, valuations are beginning to be stretched relative to the rest of the market, and we see a lot of pockets of value really emerging where those businesses have pricing power and have the ability to grow through some of this volatile macro environment we're seeing.
Has 2023 been a good or a bad time for stock picking? Has it been, you know, would it have been a better idea just to buy the Magnificent Seven and take the year off? I mean, how does the stock picking market look from here?
Yeah, well, 100% of the S&P 500's performance this year has been driven by that top 10. So really any attempt by active managers to diversify has really been punished. But we think that's set it up really well for 2024. So we're looking, for businesses with their own ability to grow. We're not talking about cyclicals here. We're talking about those businesses that can grow through these weak earning pockets and really weather, through various different macro environments. Healthcare is beginning to look really attractive here, where we see that fundamental demand coming through with lots of really interesting business models. We saw a lot of inventory dislocation that began to, really hit areas that we traditionally haven't seen impacted by inventory cycles. That's being worked through. So we're setting up for a really compelling 2024 for fundamental stock pickers.
Okay, so that's interesting. So thinking about, so you're talking about healthcare, which typically might be something you'd load up on if you're concerned about where the global economy goes. But how do you add to that ideas around sustainability and those companies that are going to benefit from, for example, the Inflation Reduction Act in the United States? A lot of governments want to spend a lot of money on greening the economy. And how do you make sure that you're investing for that structural change?
Yeah, so ultimately there are a real raft of opportunities here, and it's important that sustainable investors look globally. So you're right to call out the US. The IRA is, 15 months old now. We're beginning to see that percolate into the earnings that are being reported by businesses like Waste Management, like NextEra Energy. But it's not just a US story. So Europe looks attractive with the likes of Schneider Energy, with their Schneider Electric with their energy management products, but also within China, where there's some really compelling business models. And ultimately, if we think about that 6 to 10 trillion that needs to be invested to navigate towards a net zero future, half of that will come from EMs. And that's where we've seen a lot of negative sentiment. But we're beginning to think perhaps some of these business models are showing that resilience of growth that's so important within sustainable investing.
So if you're screening for sustainability investment opportunities, you might look at China because of the size of the economy and the push that they're doing into electrification and all things. They've got a long way to green, haven't they? And so there's a lot of opportunity there. But on the other hand, a geopolitical screening might rule out some of those investments. How do you put those together?
Sure. So ultimately, you're looking at the business models and you're looking at where those niches of technology are. A business like Wuxi Lead has really compelling EU battery technology and is beginning to export that globally. So we're looking very much on a business-by-business basis and trying to find those pockets where those business models are compelling and ultimately generate the return through the impact they're having in transitioning towards a sustainable future.
And how does that sit with the overall Fed message that we sort of started off this conversation referencing? If we are higher for longer, do we think that these types of investments and the healthcare side of things, that's the place to be? Is this all predicated on a higher for longer stance?
Higher for longer looks likely to be the scenario that we go into 2024 with. And ultimately, in those sorts of environments, you're looking for businesses that have great capital allocation decisions and policies in place to put capital to work behind those projects that generate that structural growth into the future. And it's not just in sustainable decarbonisation. You can see financial inclusion opportunities, healthcare opportunities, and even in climate adaptation, where we're beginning to look into water businesses and insurance businesses. And you see that real resilience that will deliver in periods of macro volatility.
It's interesting because when we talk about insurance, often we talk about, will areas of the world become uninsurable? And a lot of people in the insurance industry say, well, it will come down to what people are prepared to pay for in terms of premiums. So where do you stand on that sort of insurance space and how it helps the adaptation story?
Sure. So we're looking for businesses that have been early on the data story. Businesses like Intact Financial, which is a Canadian insurer that pulled their climate risk really early into their pricing decisions, generated great products and great customer satisfaction as a result. Or we're looking in the insurance broker space. Again, businesses like Aon, who can amalgamate data, scale the platforms and generate that better visibility into pricing, that better matching of capital with risk that we need to see as we navigate some of this uncertainty through, some of the global warming scenarios that we see ahead.
Yeah, and Stephanie, we're working our way towards another COP meeting, aren't we? And so the world watches as policymakers try to come to some conclusions. But for investors who are already following this trend and investing around this trend, what should they be watching for, do you think?
I think ultimately looking for that continuing commitment. In September we saw the UK begin to row back on some of their commitments, but ultimately that's politics, not policy. So we want to see those policies in place, the likes of ongoing commitment to the IRA in the US, but ongoing stimulus to continue to navigate this path to net zero that we need to happen. And I think think it will be really interesting to sense that rhetoric. And if we think about the US as well, it's interesting to see how, you know, the Democrats see this transition to a greener future as very important within their cleaner energy kind of rhetoric. But also on the Republican side, there's support across, you know, across both sides of the aisle there, because you're seeing investment in many of those rural Republican areas in the likes of renewable energy plants, you know, battery storage, that makes for a transition that's very compelling to both sides of the political aisle.
Stephanie, thank you very much. Yes, I think we've written stories on that very theme around transition in the US. Thanks for joining us. Stephanie Niven, portfolio manager at 91. Plenty more ahead. This is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of 2 earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. 8:41 here in London. European stocks then flat to negative. A little bit of weakness on the German and French markets this morning. Let's get the latest on global geopolitics. The White House says President Biden has discussed the possibility of tactical pauses in fighting in Gaza during a phone call with Benjamin Netanyahu. But the Israeli Prime Minister has reiterated there will be no general ceasefire in its war with Hamas. Officials at the Hamas-run health ministry say at least 10,000 people have been killed in the Palestinian territory. For more, let's speak to Bloomberg's Yusuf Gamal Al-Din, who's in Dubai and tracking the regional story for us. Yusuf, good morning. What is the latest on the situation on the ground as fighting continues?
Yeah, so there are exchanges of fire both on the northern border with Lebanon and alongside the Gaza Strip. As you know, this has now been divided into effectively northern Gaza and the southern part as well. From the Israeli side, they say that they've taken out some technological assets, weapon storage as well from Hezbollah in the southern part of Lebanon. The Lebanese side, from Hezbollah specifically, they say that they have struck 2 Israeli sites and destroyed equipment at another in the northern part of Israel. It's important to point out that even though we heard the U.S. president speak of a pause or a potential pause, the fact that the call for a pause fell on deaf ears on the Israeli side, and that the U.S. Secretary of State had to go now to a G7 meeting without any big victories from his meetings in the Middle East says a lot about where we are today.
Yeah, Anthony Blinken then heading to Japan for those meetings. And the UN has issued a funding appeal, Yusuf. What's the latest on the aid situation?
Yeah, so this is a request for emergency assistance to the tune of $1.2 billion. This is to keep the relief operations ongoing that have been disrupted to a very large extent. Bloomberg running a story this morning about how the people are dealing with the situation in Gaza in terms of having to plan for safety and food and water, the very basic necessities, and how all of that is evaporating by the second. Those that have made it alive out so far, they're not sure how long they're going to be able to hold on. And that call from the United Nations really underscoring the urgency. Basically, Gazans telling Bloomberg that they're dealing with dwindling supplies of water and food, and some of the missiles targeting residential areas is making it really difficult to find any place to shelter. So we'll continue to monitor that as well as the human toll continues to rise.
Yusuf, thanks very much. Bloomberg's Yusuf Gamal Eldin joining us there with the latest. Let's get to some of the other top-read stories on the Bloomberg terminal this morning. Italy is seizing more than 750 million euros from home-sharing company Airbnb, alleging it failed to pay some taxes. Milan tribunal prosecutors say Airbnb didn't pay 21% withholding taxes owed on about 3.7 billion euros of rental revenues. The US-based company says it's surprised at the action and is confident that it's acted in full compliance with the law. Bloomberg has learned that SpaceX is on track to book revenues of about $9 billion this year across its rocket launch and Starlink businesses. Sales for Starlink, in particular, are expected to outpace and exceed the launch business next year, becoming the main source of SpaceX revenue. Group sales are projected to rise to around $15 billion in 2024. Donald Trump has taken the witness stand at the $250 million civil fraud trial over asset valuations at his family real estate business. It turned out to be an eventful day in court. The former president appeared visibly angry and sometimes shouted at the judge, who asked his lawyers to control the former president. Now, Citadel's Ken Griffin says there's much more innovation in the world outside the US than before. He spoke at the HKMA Global Financial Leaders Investment Summit.
You could have been an investor in the United States at almost any point over the last 100 years, had solely a domestic investment portfolio, and have done extraordinarily well. The world's changed. There's much more innovation outside of the United States relative to 50 years ago. This morning I was with one of the prominent Chinese business leaders. The management teams in China are extraordinarily capable. They produce extremely competitive products on the global stage. They lead in many areas that are important to the world: solar, EVs. These are really important competitive advantages that exist in China. Companies, great management teams, great products. If you're a global investor, you've got to be watching and investing here in China.
John, in your current position, I assume you deal with regulators and administrators all the time. Do you find that an uplifting experience to go talk to them about convincing them about your point of view of things, or not so uplifting?
I'm only going to say positive things about those experiences.
Okay, so you like that part of your job.
And I'm going to make sure all my future meetings are with him then.
Okay.
We can go together to Washington if these are your experiences.
So, John, how has the large global private equity firm that's publicly traded evolved in the last 10, 20 years or so?
Well, the business, as you know extremely well, having created one of these firms, was pretty narrow. I mean, we were basically in high-octane strategies in private equity, real estate private equity, and distressed credit. We were trying to produce 20 gross, 15 net, and we had a small number of customers. And when you look today, you've seen a real evolution of the business model. We've expanded who we serve, insurance clients. Individual investors have grown to be, almost a quarter of what we do. Many more institutional investors, and we've moved down the sort of risk-return spectrum into things like direct lending to companies, asset-backed finance, infrastructure, lower returning core plus real estate. And so the total available market is much larger for what we do today. And we continue to see this migration from all sorts of pools of capital towards alternative assets because of the return premiums that have been generated.
That was the Citadel CEO, Ken Griffin, who you heard first, and the Blackstone COO, John Gray, on stage there, talking about how their businesses have evolved and a little bit on regulation. Sticking with events coming to us from Hong Kong, Schroders Group CEO Peter Harrison says there's a long way to go, about a year in fact, before we reach market normalization. He also spoke from that Global Financial Leaders Investment Summit in Hong Kong.
We're in an environment where the data is about as dirty as it's ever been. And we've got the post-COVID savings. We don't quite know how they're washing through. We don't know what the inflationary impact of commodities washing through is. We've got all sorts of deglobalization trends. We've got decarbonization trends. I think that understanding corporate profitability and understanding defaults is particularly difficult right now. And as Bob was saying in the last session, the issuance cycle is against us all. So I think we're in a really difficult period where the data is really noisy. And frankly, there is a very significant outflow across pretty well all equity market platforms around the world of people saying, I prefer cash. It's worth understanding that the average retail investor lost, the more low risk they were last year, they lost 10, 15, 20% of their money. So when you offer them the opportunity to put some money in cash with a guaranteed return, they're grabbing it with both hands. I personally feel there's quite a long way to go before we feed to some sort of normalization. We're 1 year into a new normal. That takes us another 12, 13 years of party time to wash through. And that isn't going to happen in a hurry, right? We haven't yet found out where all that debt went. I mean, if you take a step back, between equity markets used to grow pretty much in line with GDP. Since 2000, they've outperformed GDP by about 130%. Real estate is outperformed by 33%. There's a very, very significant growth in wealth, about 160 trillion of excess return that's been created in the world largely through debt. That reset is going to take a long time to wash through.
That was the Schroders Group CEO, Peter Harrison, speaking to us there. Coming up on the programme, the RBA hikes rates by 25 basis points, saying inflation is still too high and risks remaining elevated for longer. It was a fairly dovish hike, though, according to market response. We'll discuss that next. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Services markets today. We are 52 minutes through our European trading session for this Tuesday morning, and European stocks are flat to negative this morning. Let's get to some interesting news just breaking from Germany and from Spain. We have a red headline across the Bloomberg terminal tells me that Telefonica Deutschland shares have risen as much as 42% on this offer from Telefonica. So at the moment they're up by 38%, I can see, but the shares were up even more than that. Telefonica is offering to buy most shares of its German unit that it doesn't already own for as much as 2 billion euros. This is a premium of around 37.5% to Monday's closing price, according to a statement coming through from the business. So Telefonica currently owns 71.8% of Telefonica Deutschland, either directly or indirectly. So we'll watch that with interest. Let's talk about some of the wider themes that the macro themes we're dealing with in these markets. Noor Al-Ali joins us from our Markets Live team and can take us through some of the latest themes in focus. Good morning to you, Noor. Nice to have you with us. Let me just ask you about what's going on in Australia, for Australia's sake, but also for the global story, because it's really interesting to see a central bank pause for month after month after month and then hike. And I wonder if that has any kind of global resonance for us.
Yeah, absolutely, because we know that generally the RBA's policies usually come before all these other central banks, but this time around they've actually come after. And while the market was potentially gearing 50-50 for another pause, despite the hike that they've come, it was a lot more dovish because growth is still very much in concern. And also in the meantime, inflation resurging really does show you in a global picture that central banks have a very fine balancing act to come here when it comes to raising interest rates or maintaining tighter policy while also reining in on inflation and keeping growth in check.
Yes, and thinking about that inflation and reining in on inflation, this is interesting in the UK context. We've had some interesting commentary over the last 24 hours from the UK's chief economist, the Bank of England's chief economist, Hugh Pill, talking about how the UK inflation will soon match the rest of the world. And this is interesting because the UK has seemed elevated versus certainly other developed market peers. Recently, we've still got a 6 handle on inflation, where other European countries, for example, are talking about 4 or maybe even 3 as the handle. Now, it is set to come down quite substantially next time around, I think, inflation in the UK. But give us the context here.
Yeah, absolutely. And those comments have definitely helped the bond market in the UK today really ease. So you have seen yields across the curve dropping today in the UK because of these comments. And he also did push back on comments on the market's expectations of cuts here. But he did say, we could potentially see those cuts starting to materialize sometime next year. So there's a lot of optimism here coming from the Bank of England. But just a reminder here that the Bank of England generally does lean more dovish than the other major developed central banks. In comparison, I'll give you Kashkari, who said, it's too early for us to declare victory on inflation. And potentially, I think the UK faces that difficulty of balancing market expectations with growth concerns, especially as we go into the fourth quarter, where we are expecting growth. The BOE itself is expecting growth to be quite subdued.
Noor, thanks very much. Thanks for joining us, Noor Al-Ali from our Markets Live team. Remember, you can get up-to-date analysis and insight from Noor and the rest of the Markets Live team. Mark Cudmore, of course, leading that team. MLIV Go is the function to use on the Bloomberg terminal if you want to keep across all of the thinking of the Markets Live team. That is it for Markets Today. You can get insights from the Markets Today blog. Go to the Bloomberg UK website, click through to the blog from there, or type TLIV Go on the Bloomberg terminal. The Pulse is up next. They'll continue to bring you more on the UBS story, plenty more global coverage of these markets. That's coming up shortly. This is Bloomberg.
this story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, hi everyone, and welcome to The Pulse. I'm Francine Lacqua, this time from Singapore with the conversations that matter, and here's what's coming up on today's program. UBS shares rally on client inflows and cost-saving goals, despite the bank posting its first quarterly loss in almost 6 years following the integration of Credit Suisse. China's trade data offers a mixed economic outlook. Imports higher than expected, but exports suggest global demand for Chinese goods is struggling to gain traction. Plus, Aramco maintains its payout to the Saudi government and investors at more than $29 billion, despite third quarter net income dropping by almost a quarter. So first thing is first, let's take a look at the European markets map. A lot of the focus, of course, is on what the Fed said will do or won't do. Now, the focus today's stocks actually retreating somewhat. The dollar rising again after the Fed. Policymakers seem to have dampened some hopes of speedy interest rate cuts from the U.S. central bank. Now, if you look at dollar and U.S. Treasury yields, they rose for a second day after we heard from the Minneapolis Fed President, Neil Kashkari, saying really it's too soon to declare victory over inflation. He did also say that over-tightening monetary policy is preferable to doing too little. Then in the last couple of minutes, Anna Edwards actually broke the story on air for us. Telefonica Deutschland shares rising some 42% after an offer on Telefonica. Telefonica offering to buy shares it did not already own in its German unit, Telefonica Deutschland, for €2.35 per share. That's according to a statement, and you can see on the back of that, Telefonica Deutschland going to $2.35 as expected, up 38%. Now we're here in Singapore for Bloomberg's New Economy Forum, which gets underway tomorrow, Wednesday. This year's theme, embracing instability. Now we'll be hearing exclusively from world leaders, from policymakers and executives on inflation, geopolitical tensions, the rise of artificial intelligence, and the climate emergency. On Thursday, we'll also have a sit down with the UBS chief executive Sergio Ermotti. Now, speaking of UBS, a Swiss lender this morning posted its first quarterly loss in almost 6 years as the ongoing integration of Credit Suisse drags on the bank's performance. Now, UBS says it has now pretty much stabilized its former rival Credit Suisse. It's also warned investors to expect another $1 billion of integration costs in the fourth quarter. So let's get straight to Bloomberg's Guy Johnson, who's in Zurich with the very latest. So Guy, it's unclear. I mean, it seems positive news overall because UBS shares are gaining 3%. What did you learn?
Look, this is a really messy set of numbers, Francine. The market's kind of feeling its way through them.
there is no comparison here that you can make to any other quarter. In terms of estimates, I'm not sure really how much value they are. We're kind of feeling our way through this process, as is obviously senior management at UBS. Look, I think the market is signaling that there are probably more positives than negatives here. They've stuck to their 2026 targets, which I think a few analysts were concerned were a little too optimistic. There seems to be signs of stabilization in terms of the client story at Credit Suisse. That's great news. The cost story is coming through maybe a little lighter than anticipated. But to be honest, Francine, this is a bridge quarter. We're waiting for the full year. We're waiting for the big strategy update. We're waiting for the 3-year plan. That's what the market is looking at next. This is an incredibly messy set of numbers. The market's kind of feeling its way through it, but really waiting for that big event at the full year.
So it does seem, Guy, the advisory business has outperformed some of their peers. What are some of the big questions that people are waiting for? Is what does this bank become in 3 years, or is it just on cost cuts and job losses?
I think it's all of those things, isn't it, Francine? We are in the midst of a really big integration. We haven't seen an integration like this for decades. The cost story, the integration, the IT, the personnel, all of that sort of stuff's really going to matter. This is a massive opportunity for UBS. What the bank becomes going forward, I think we're going to have to wait for the full year to figure that out. The advisory business has done a little bit better, but maybe in other areas in the iBank, maybe we haven't done as well. I think the big question a lot of people are going to be asking themselves at the moment is kind of how distracted is management? And it's interesting you bring up these sort of two areas. How distracted is management going to be by the integration? And will it have the bandwidth to also focus on kind of what the ongoing business is going to be looking like, what the iBank is going to be looking like, what advisory is going to be looking like within that, what trading is going to be looking like within that, making sure that they can retain people. They're clearly putting some money aside to make sure they can retain people. But this is a really complicated process that management is going to be going through here. It is very messy, and that I think is reflected in the numbers. I think the market's just breathing a sigh of relief, kind of from the signals thus far that things basically are on track. And I think we're just waiting for more details. There's no kind of landmines within these numbers. Progress is clearly being made, but we're going to have to wait for the full year before we get the full picture.
Guy, thank you so much. Great reporting there on the ground in Zurich. Our Guy Johnson in Zurich on UBS. Now, after the best week of the year for U.S. stocks, JP Morgan's Marko Klanovic says equities will soon be unattractive to investors again. That's as a prospect of sustained elevated interest rates and, of course, slowing growth comes back into focus. Well, joining us now is Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank. Grace, great to have you on the program. When you look at, I guess, the bets of the markets of cuts from the Fed, are you confident that they're not going to continue raising rates for too much longer?
Good morning, Francine. So lovely to be here. I think there's no doubt that the trajectory of interest rates is going to be a key driver of stock markets over the short term, but also over the longer term. In the short term, we've got this data dependency coming through, and we do think that the last Fed hike has been enacted, and also the last ECB hike, that we're going to be on this, higher hold until the middle of next year. So if I look at market pricing for the Fed specifically, I think it could be a little bit over-optimistic starting to price that first hike in June. It might come, a little later in the summer than that. And on the flip side, ECB pricing, perhaps you could see ultimately the ECB move a little bit earlier than current market pricing. But I don't think we're out of the woods yet. I don't think any central banker will want to declare victory on inflation, thus the data dependency, and therefore markets are to some extent beholden to the rate outlook. And just to extend on why I think that's here to stay for the long term as well, we are in the midst of a regime shift. We're moving away from a world, I think, where monetary policy will be ultra low, negative in some parts of the world, and to a place where you've got upside risks to inflation over the longer term. And that means that the Fed put that many have relied on over a couple of decades might not be something we can rely on over the next 10 years.
But Grace, if we're at a turning point then in interest rates, is it better to over tighten than actually to under deliver at this point? Is that, if you look at the two evils, what's the right way for central banks to think about this?
I think it's a very delicate tightrope to walk, because the risk of over-tightening is, there are certainly parts of the market, parts of the economy that maybe thrived when rates were zero but can't thrive when rates are at 5%. And I think that, therefore, the longer that monetary policy, rises, the higher it goes, the greater the risk of a more systemic mistake. I think central bankers are better to hold rates at these high levels for longer rather than take the terminal rate higher itself.
So where, at the moment, what are you buying, equities or actually bonds, and when's a good entry point?
So I think there's actually a reasonable entry point for both at the moment, but if I had to sort of choose one right now, it would be on the fixed income side. I think that when you look at the level of yield, which is normally a really good indicator of future returns, they're at exceedingly attractive levels, particularly if you look at investment grade credit in the US or in Europe. And for our clients, what we're often trying to achieve is a particular goal, a financial goal, but with as little risk as possible. So when we think about the front end of the curve, let's say 3-year maturities where you can get around, a 6% yield with a buy and hold strategy, that looks incredibly appealing as a way of stepping out of cash, where obviously rates are very attractive as well, extending the period of time over which you can capture that yield without taking undue duration and therefore interest rate risk. So that would be sort of where I would go first and foremost. But I think below the surface of the equity market, there's some really interesting trends playing out. As I mentioned, whilst rates are going to be, I think, what causes us to whipsaw in the coming weeks and months. Third quarter earnings season marks its own inflection point. Whilst we think GDP in the economy is going to slow, this is the first quarter in several where you're actually seeing earnings rise about 3% for the S&P. And within that, capex trends, when you look at the real economy, also improving in a way that we think gives reason for optimism. So happy to pay higher multiples for troughing earnings on a go-forward basis.
Yeah, and some equities, Grace, also look pretty cheap. I don't know whether there's an entry point for that or whether they're cheap for a reason and will stay under pressure for the foreseeable future.
I think that I would still absolutely stay up in quality. To the earlier part of the conversation when we spoke about the ability for all parts of the economy to function at these higher rates, I'm sceptical of that, and I think more distress in pockets of the market is ahead. So I would stay up in quality, but another key facet of, the US stock market and parts of the European stock market is the strength of the balance sheet and the potential for shareholder return. And so I think I would look to those, sort of companies with a strong competitive moat, with the potential for good shareholder returns to drive the equity part of the portfolio. And I think entry points, into that complex look fair right now.
Grace, I know there's a lot of talk about the 60-40 portfolio, whether that's still viable and whether it will continue to be the basis of a lot of investment funds in the future. And you think this is still the fundamentals of what we should be looking at?
So we do. I think the 60-40 portfolio, which obviously there's much debate and has been much debate, a lot of that debate centred around the role of bonds. Can bonds do what they're supposed to do, which is yield and protection, in an ultra-low environment? And they obviously couldn't, whereas now we think you're at levels where the fixed income part of that 60-40, the 40% that's fixed income, can do the job as intended. So we think that's a really good starting point, in building a portfolio. But I also mentioned regime change, Francine, and the fact that we could see more topside risks to inflation over the next decade. And therefore, I probably wouldn't just go for a 60-40 portfolio. I think that also to protect for those topside risks, you want to add in alternative assets, particularly infrastructure assets that can benefit not just from, those topside inflation risks, but also from some of the structural changes, many of them around the theme of security, of national security, that will play out in markets. And I think that would make a very healthy complement to the 60-40 portfolio over the longer term.
Grace, as always, thank you so much for joining us. Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank. Now, we'll be back. We have plenty more, of course, on investing, especially in China. China's export slump unexpectedly deepened last month as the country tries to stabilize its economic recovery. More on that and the country's latest property developer troubles next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
So you told your mother you'd like to go to Africa and see the chimpanzees, and what did she say?
Not the chimpanzees, I would have studied anything.
Well, what did your mother say to anything?
If you really want to do this, you're going to have to work really hard. And if you don't give up, hopefully you find a way.
There's much more innovation outside of the United States relative to 50 years ago. This morning I was with one of the prominent Chinese business leaders. The management teams in China are extraordinarily capable. They produce extremely competitive products on the global stage. They lead in many areas that are important to the world: solar, EVs. These are really important competitive advantages that exist in China. Companies, great management teams, great products. If you're a global investor, you've got to be watching and investing here in China.
Ken Griffin there, the Citadel co-founder and chief executive officer. Now joining us for a rundown of China's October trade data and more is Bloomberg's Shanghai bureau chief, Charlie Zhu. Charlie, thank you for joining us. So what do the figures out today actually tell us about the state of the Chinese economy?
The October trade data offered some quite mixed picture for the outlook of China's economy. So today's figures show imports rose 3% last month. That's the first increase in about 8 months, which is good. And also that, compare with, a consensus forecast, which is for a drop. So import did extremely surprisingly well last month. That probably signaled a rebound in Chinese consumer confidence. But exports fell more sharply than expected, and that shows just shows uncertainty still remains in terms of global demand for Chinese goods, and exports to China's major markets, including Europe and the U.S., dropped double-digit in the first 10 months, which is not a good sign for the economy. The broader picture is China's government has done made tons of efforts to prop up the economy. It has, cut interest rates. It has, boosted deficit spending. They're issuing an extra like 1 trillion yuan sovereign bonds, for infrastructure spending. And there's talk, about more cuts in reserve requirement ratio, which is the amount of reserve banks must set aside, for lending. And in addition, it has, cut mortgage lending rates and also down payment ratio in order to stimulate home buying. So all of those measures, are are being adopted to pump prime the economy. IMF this afternoon just revised up its GDP forecast for this year and next year, probably reflecting confidence about the future for now.
And Charlie, the Chinese developer Vanke also got official support. Does that mean a shift in government stance on the entire property sector?
That's probably just a standalone case. Vanke is a state-controlled company. It's one of its main shareholders is Shenzhen Metro, which is relatively in a financially strong position. Unlike Country Garden and Evergrande, which are controlled by the state, Vanke is a state-owned entity, as you know, and it's relatively well-known. It's a household name in China, and it's known for its financial prudence. So apparently, authorities are trying to avoid a loss of confidence for the entire sector if it doesn't show any support for a big name like Vanke. Yeah, reflecting, a lack of confidence in private sector, Evergrande and Country Garden are seeing their bonds trading at fraction of their value, just a few cents on the dollar. I mean, what's clear is the Chinese government is trying to avoid, a bailout of entire sector of individual developers, but you definitely want to achieve a soft landing of the overall sector, which is too important for the overall economy.
Charlie, thank you so much. Our Bloomberg Shanghai Bureau Chief, Charlie Zhu. Now, we'll have plenty more, of course, on the pulse shortly. Coming up, President Biden discusses the possibility of tactical pauses in Gaza with Israel's Benjamin Netanyahu. We'll bring you the latest from the Middle East next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried had pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Well, the White House says President Biden has discussed the possibility of tactical pauses in fighting during a phone call with Benjamin Netanyahu. But the Israeli Prime Minister has also reiterated there will be no general ceasefire. Now let's get more with our EMEA News Director, Roz Matheson. Roz, good morning. So what more do we actually know about the call between the two leaders?
Well, we don't have a lot of detail about that conversation. What we do know, as you say, is that there was a further chat about the possibility of getting these tactical pauses or halts, or whatever you want to call them. They're not using the word ceasefire, obviously, in the fighting to facilitate the movement of people potentially from the north of Gaza to the south of Gaza to allow more aid to come in. But of course, all those conversations seem to be about those pauses being very, very brief, a matter of hours, if that. And what that achieves is hard to see, because how do you get a lot of people on the road in that shorter period? And Hamas has shown no great inclination either to allow people to move from the north to the south. So all this conversation seems to be about very, very brief windows in time, with a lot of questions about what that might actually achieve, and no one really willing to put on the table a proper conversation around a ceasefire. But what you are taking away from that latest conversation between the leaders of the US and Israel, and they've talked several times, obviously, since the war broke out, is, again, the rising level of concern in the US also about the situation inside Gaza itself.
So what is the situation on the ground in Gaza?
Well, obviously, as we enter the second month of this conflict and about sort of 2 weeks into the ground war inside Gaza, we know the fighting continues. We know that Israeli troops have essentially encircled Gaza City. There's been limited operations inside Gaza City, but a real sort of proper ground war inside Gaza City is likely in the next day or two. And what that means, of course, is door-to-door fighting and a further escalation.
Roz, thank you so much. Roz Matheson there with an update on what's going on in Gaza. Coming up, Bloomberg New Economy Forum kicks off here in Singapore tomorrow. We'll have plenty of big names, of course, in attendance. We'll preview the event next. We talk China, also with our chief economist, Tom Orlik. That's next, and this is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. It's DC FinTech Week, and Bloomberg is on site. Live from Washington, Kaylee Lyon speaks with Grayscale CEO Michael Sonnenschein and others. Tune in for a special 1-hour episode of Bloomberg Crypto. Bloomberg. Context changes everything.
This is Bloomberg.
UBS shares rally on client inflows and cost-saving goals, despite the bank posting its first quarterly loss in almost 6 years following the integration of Credit Suisse. China's trade data offers a pretty mixed economic outlook. Imports higher than expected. Exports suggest global demand for Chinese goods is struggling to gain traction. Plus, Aramco maintains its payout to the Saudi government and investors at more than $29 billion, despite third quarter net income dropping by almost a quarter. Well, good morning and good afternoon and welcome to The Pulse. I'm Francine Lacqua here in Singapore. Now, here at Bloomberg's 6th annual New Economy Forum in Singapore, this year's theme is embracing instability. Now, the event kicks off tomorrow, bringing together global leaders in finance, politics, and of course, economics. Now, joining us for more on what to expect and the current state of the global economy is Tom Orlik. He's our chief economist at Bloomberg Economics. So, Tom, thank you so much for joining us to really set the scene. We have some great speakers from China to the world of business to governments. What are you most looking forward to?
So I think people are going to be really interested to hear from China's Vice President Han Zheng, who's topping the agenda on Wednesday morning here in Singapore. Now, I think the crucial thing here is partly that this is a really challenging moment for China, facing a slump in the real estate sector, facing very challenging relationships with the United States. But it's also that we don't get to hear very much from China's top leaders in this kind of setting.
And so a message maybe to investors? I mean, what does China right now need from the rest of the world?
So China has been at pains over the last several months to kind of pull back some of the severity of the messages which people have come to sort of see as characterizing the last few years, right? People came to see China as anti-business. People came to see China as actively hostile in its relationships with the United States. And the last few months have seen China trying to layer on a bit of nice, right? They went to the World Economic Forum and talked about how they were open for business. They've talked about how they were going to try and boost imports. I think people are going to be interested to see whether Vice President Han can extend that message, and also whether he can kind of break out of that kind of rigid formality which very often characterizes Chinese communication and put a bit more of a kind of human face on China's engagement with the world.
Tom, how would you describe the Chinese economy right now? I know when it comes to property, so the government stepped in, I think, with a bit of support for Vanke. Is this a one-off, or do you see it as policymakers understanding actually that they maybe have to step in more to try and support the property sector?
So the property sector is really kind of a really significant challenge for China. Property was the biggest driver of growth, but they really overdid it. There was too much building. A lot of that was financed by taking on too much debt. And to China's credit, they realized that wasn't sustainable. So they moved in and tried to address that problem of oversupply in the property sector before a crisis broke out. Trouble is, That's a painful process. And now we've got stimulus coming in to try and not reinflate a real estate bubble, but put a floor under growth as the real estate bubble continues to deflate.
So is the Fed, and I know that the Fed has a whole set of problems, and of course sets monetary policy for the US, but how is the Fed looking at China and the rest of the world?
So the US is a continental economy, right? It's a continental economy. And what that means is what happens in the rest of the world is kind of important, but it's really not that important. It's really domestic drivers which matter most for the Fed. So there's a nightmare scenario where China's real estate slide turns into a real estate crash, and that starts to hit commodity prices, it starts to hit global financial markets, and the Fed says, you know what, this is serious, we have to start taking this into account. That's happened in the past. That happened in 2015 when China's equity markets and China's yuan were melting down. But we're not there yet. And I think what the Fed is going to be looking at much more closely is what they see on unemployment, where we're expecting a tick up, and what they see crucially on inflation.
But there's no, and the market at some point always tries to price in cuts. Are we there yet?
So our expectation, our base case for the United States is that all of the tightening we've seen from the Fed so far tips the economy into a shallow recession at the end of this year and extending into 2024. We're not talking about a very, very hard landing. We're not talking about unemployment spiraling higher, but we are talking about unemployment edging further up from where it is now, and the MBER seeing enough evidence of a downturn to say, you know what, this is a recession. Now, on that scenario, the Fed is done. There's no more rate hikes, and as we get into 2024, cuts start coming onto the table.
So we heard from one of the Fed presidents, and it was interesting. He was saying, look, if you look at the juncture in time, it's better to over-tighten, so actually maybe increase interest rates by a little bit too much rather than underdo it. Is he right, or what's the biggest policy mistake right now?
So I think if we sort of roll the clock back 6 months, certainly if we roll back the clock a year, when inflation was way above the Fed's target and there was deep concern about inflation expectations taking off and a wage price spiral, certainly you could make a case that doing too much was better than doing too little. As we approach the end of the Fed tightening cycle, I think the risks look a little bit more evenly balanced on both sides.
I mean, we have also quite a lot of corporates here at the New Economy Forum, so we'll be joined by the UBS chief executive. We have a number also of Chinese entrepreneurs and businessmen. Are you still surprised that we haven't seen more defaults or more of an impact on these rising interest rates in the real economy?
Well, you mentioned UBS, Francine, and of course UBS is a bigger organization than it was before the ECB began its tightening cycle. What happened to Credit Suisse? Well, a lot of things, a lot of management missteps, some bad luck as well, but the backdrop was those sharp increases in interest rates, which triggered stress first in the US banking sector with the failure of those small regional banks, and then that knock-on effect with Credit Suisse losing investor confidence and going under. So am I surprised that we've kind of got away with it, if you like, that a soft landing for the US and for the euro area is possible? Yeah, I think we've managed down inflation at remarkably little cost, but it's not been zero cost, and we think there's more cost to come in the months ahead.
And Tom, of course, as a backdrop, and everybody's watching what's happening in Gaza, what's happening in Israel, what's happening in Ukraine, and so that must pull back investments, right? People are in a wait-and-see situation where they're also very uneasy about world events.
Yeah, I think that's completely right, and I think that's going to be very much in focus at this year's New Economy Forum. We have extreme tensions between the United States and China. The Trump-era tariffs still in place, the Biden administration going further and blocking sales of advanced semiconductors to China. We have Russia's invasion of Ukraine. We have war between Israel and Hamas and all the human suffering that brings. And of course, all of these geopolitical stresses are factors which weigh on growth and add to inflation risk as well.
Are you seeing, when you look at data, are you seeing actually companies just not spending money right now until they understand where the world ends up in 12, 24 months? We also have the US elections to look forward to.
So uncertainty isn't good for investment, right? If businesses, if households don't know what the world is going to look like in 1 year's time, 2 years' time, 3 years' time, then where do they build their new factory? Where do they invest in building new retail outlets? If they don't know if their supply chains are going to be broken, if they don't know where there's going to be war and where there's going to be peace, well, that's a drag on future investment, a drag on future growth.
Yeah, and of course, underpinning all of this is the cost of money, right? And so the cost of credit, I think you had a great research piece on this. Is it still the main driver of what a lot of these chief executives are thinking about?
So we've seen a remarkable run-up in borrowing costs in the last few months, Francine, as you know. The US Treasury 10-year yield getting up close to 5%. Now, a lot of that is being driven by inflation and by the Fed and by the global tightening of monetary policy. But behind the scenes, we think there's something else going on as well, something a bit more structural. Demographic factors are changing. As the baby boomer generation approaches retirement, we're seeing saving levels come down. As US-China relations modulate, we're seeing less Chinese saving coming into the US Treasury market. As the fight against climate change ramps up, we can expect more investment demand. If you put those pieces together, you've got less saving, more investment, and that means higher borrowing costs, a higher price of money. Well, it's not just a function of this tightening cycle and this Fed, it's actually a structural trend, which we think is going to persist in the years ahead.
So interesting. Tom, thank you so much. As always, Tom Orlick, there, our chief economist at Bloomberg Economics. Now, coming up, we'll have plenty more from the New Economy Forum. We'll also look at Saudi Aramco. Its net income dropping 23% in the last quarter. We'll drill down into those numbers next. This is Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
The conversations that matter, the insights you need. This is a pulse, and I'm Francine Lacqua here in Singapore. Now let's talk oil, and Saudi Aramco is maintaining its payout to the government and to investors at $29 billion. Now that's despite third quarter net income falling 23% compared to a year earlier. Now for more, let's bring in Bloomberg's Middle East energy markets reporter. He's Anthony Di Paola. Anthony, great to speak to you. So a challenging quarter for Aramco. What do we take away from the earnings?
Yeah, good morning. Well, that was in line with what a lot of the industry was doing. A lot of the companies, the big oil IOCs that reported last week, were showing that the profit had come down from last year when we had those bumper profits because of all the volatility in the oil market, the Russian invasion of Ukraine that pushed oil up to an average near $100 last year. We've seen that come down, so that decline in the oil prices has been hurting earnings. But what Aramco's done here is they've taken some of those bumper profits from last year and they're using those to create part of this special dividend that they're giving out this year. So last quarter and this quarter, they've given out this special dividend on top of their already generous regular dividend. So that's about, as you said, about $30 billion that they're returning to shareholders, mainly the Saudi government, which is really reliant on that oil income to support all those ambitious growth targets that is trying to move that country into being ready for this post-oil age, Francine.
So, Anthony, how is the Middle East conflict and production cuts actually impacting oil?
Yeah, well, oil's come back down to even below where we were before the Hamas attack on Israel on October 7th. So we've kind of lost all of that war risk gain. So showing that the market is really shrugging off the risk of that conflict, broadening to a broader regional conflict that could impact oil supplies to the region. We've got these lingering concerns about demand, mainly in China, and some worries about whether the Fed is finished tightening or not tightening, and how that's going to impact the economy there. So these things are really playing into the oil price, creating some concerns for the future, and that's what's keeping Saudi Arabia and their partners Russia, leaders of the OPEC Plus group, on that track of cutting production. They just said over the weekend here that they would continue their rounds of unilateral cuts through the end of the year, through December, and they left open the possibility to continuing those next year. So those concerns are not going away in terms of sluggish demand, even though Saudi Arabia and OPEC see that longer-term picture still one of increasing demand. But they are concerned about the medium short term, and so that is going to continue to weigh on the minds here, potentially weigh on the oil price and the earnings of companies like Aramco, Francine.
Anthony, thank you so much. Anthony Di Paola. There are plenty more, of course, to come from the New Economy Forum here throughout the day and over the coming days. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The backstory is that Rolex acquired a Swiss retail group because they were concerned about continuity of ownership without any succession. So they did, I think, what was a very elegant thing and just acquired the group. Rolex make a lot of investments that they handle, as investments, hands off, and they've been completely clear and reassuring us that's the intention here. They're not going to get involved operationally. And, when nothing changes, I've had that reassurance. I've been able to confirm it to the market. So it's not something that affects our business model or plans at all. We're confirming that that's the case again. We've actually got the biggest and longest list of projects that we're doing with Rolex over the next 2, 3, 4 years. So it's been a bit of a non-issue and an overreaction of the market. Yeah.
Talking about consumers and their appetite for luxury watches at the moment, are you seeing any changes in appetite, in waiting lists for luxury watches at this point? We're always looking for clues as to whether there are any cracks.
Yeah, no, honestly, there's no change. More than half of our business we sell to clients on what we call the registration of interest lists. Those lists continue to grow, actually, and conversion of the lists when we contact the clients is very good. So we're really seeing no change. As we've said before, we're not immune to kind of consumer confidence with some of our business categories, like jewellery, for example. But most of our business is the watch business, and we are seeing a continuation of healthy demand. The US market's particularly very strong for us. The market's underdeveloped, which I think is accepted. I think we're proving our model's working. We're gaining market share. So, things carry on positively overall.
You talk about the waiting list, and you suggest that there's nothing changed there as well. Just to dissect that a little bit, sometimes we talk about waiting lists at the higher end, Rolex and Patek, but I wonder what you're seeing on other brands. Are you also seeing on other brands that there's no change in the sort of dynamics of the waiting list?
Well, I mean, the other brands are, less impacted by waiting lists. But overall, we represent the best brands in the world: Omega, Cartier, Breitling, TAG Heuer, Tudor, in addition to Rolex, Patek, and Audemars. Some slight changes in market demand. I think, in a positive note, there's a lot of interest in, the smaller, more independent brands. Again, particularly in the US, where you get a lot of innovation and a lot of difference. But the world of watches, the fundamental is there's just not enough Swiss watches in the world. Demand exceeds supply, and the big trends overall, remain very strong.
Well, that was top UK Rolex retailer Watches of Switzerland Chief Executive Brian Duffy speaking with Bloomberg's Anna Edwards. Now, the company is a top riser this morning on the Euro Stoxx 600. Some of the other stories we're watching now: Donald Trump has taken the witness stand at the $250 million civil fraud trial over asset valuations at his family real estate business. It turned out to be an eventful day in court. Now, the former president appeared visibly angry and sometimes shouted at the judge, who asked his lawyers to control the former president. The FT reports that PwC plans to cut 600 jobs in the UK. This comes as reduced resignations push the company to make staff redundant instead. Now, sources told the FT that accounting firm will launch a voluntary redundancy program and will cut jobs if not enough people opt to leave. PwC was the last of the big four to hold out against UK job cuts. And Bloomberg has also learned that Goldman Sachs is revamping how its asset management teams are rewarded, boosting payouts when funds outperform. Now, sources say the changes will lift the shares of profit for teams directly responsible for the performance of Goldman's alternative investment funds. In the UK, grocery price inflation has slowed for the 8th straight month to 9.7% year-on-year. Now, according to Kantar, supermarkets are using special offers to entice shoppers away from rivals, while discount grocers are still gaining customers, with Lidl sales growing at the fastest pace amongst supermarkets. Anna Andrade from Bloomberg Economics joins us now with the very latest. So, Anna, thank you for joining us. Food inflation falling rapidly. Will the consumer actually benefit anytime soon?
Hi, good morning. So today's data showed that the food shop inflation is falling rapidly. We're actually going to get CPI data for October next week, and we expect a big drop in inflation there from 6.7% in September to 4.8% in October. Now, that will be driven by energy bills and some base effects there, but food will definitely also help in bringing the headline down. So, that's good news for the economy. Whether that's good news for the consumer, it really depends on how you look at it. If we look only in isolated terms to the fall in inflation and with the fact that, nominal wage growth is still pretty high, then this recovery in real incomes should really help the consumer in the coming quarters. But if we take a step back and look at everything else that's weighing on the economy, such as falling house prices, a cooling labor market, interest rates getting to a higher number of households, and the fact that, excess savings from the pandemic have kind of run down, then, the outlook for consumer demand is actually not that bright, and we expect it to actually be subdued over the next coming quarters.
So, Anna, what was your main takeaway, I guess, from the retail sales data? What does it show you for also the coming quarters?
Yeah, so today's retail sales was actually one of the first few indicators that we have on the fourth quarter. We're going to get GDP data on the third quarter on Friday, and we expect that to show the economy contracting. We already have the data out for July and August, so we're only missing September. And assuming that there are no data revisions, it's really hard to see the economy not contracting in the third quarter. But today's data on retail sales was kind of a sign that, this is unlikely to be just a temporary contraction, and that it will be kind of a more prolonged downturn.
Thank you so much, Anna Andrade, there, a Bloomberg economist. Now, just before we go, a reminder of what's coming up here from the New Economy Forum in Singapore. It gets underway a little bit later this week, and this year's theme is Embracing Instability. Plenty of big-name interviews for you. We'll be hearing exclusively from world leaders, policymakers, and executives discussing challenges, including inflation, geopolitical tensions, artificial intelligence, and the climate emergency. You can see some of the names up there joining us: Ken Griffin, John Kerry, Macquarie Group Chief Executive, the UBS Chief Executive, and also the Saudi Arabia Minister for Investment. Up next, Bloomberg Brief with Danny Berger in London and Manus Cranny in New York, and this is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Manus Granny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
UBS posts its first quarterly loss in almost 6 years as the ongoing integration of Credit Suisse drags on performance, but shows rally as client inflows progress in meeting the cost-saving goals. Fresh doubts emerge about whether the Fed has finished tightening. Neil Kashkari says the fight against inflation isn't yet done. And Aramco maintains its payout to the Saudi government and investors at more than $29 billion, despite the third quarter net income dropping by almost a quarter. Good morning. You were supposed to be done with the Fed hiking, but the bottom line is Neil Kashkari went whoosh. He just utterly emaciated the bull scenario because he'd far rather over-tighten than perhaps do a little bit less. So you've got a small reaction in equities this morning, down 0.25%, but the SLOOS report, Danny will pick this up in a moment, there's a tightening of consumer credit. The consumer, remember them? They spend until the last moment in the United States of America. NASDAQ down by 0.25%. Again, we're going to get more earnings coming along the slate today. Russell 2000, which is the belly, the very belly of America. There are profit warnings galore. Danny pointed out this morning, there's more of a debt cliff edge in the Russell 2000, and you've had 500 days without hitting a new record high. Couple of stocks to watch for you. UBS, we'll talk to Guy Johnson in just a moment. It's up. They're doing the classic Omotti, front-loading the costs, front-loading the restructuring. Know your pain, know your trade. Watches of Switzerland, I don't have a Rolex, but I have it on good authority. It's one of the pumping prices in Europe today, as the CEO tells us, the second-hand market. Maybe I can pick up a cheaper Rolex in the second-hand market if the cracks come to bear on Rolex. Watches of Switzerland, go on, up 8.5%. Danny Berger, good morning.
Good morning, Manis. I got bad news for you. The second-hand market is still too expensive for me to buy you a Christmas present there. I regret to inform. Like, on the cross-asset picture, it is remarkable that equities held up yesterday, considering what this bond market has been doing, this absolute whiplash. We are having a rally this morning, down by about 30 basis points for your 10-year yield, matching what we saw last week. But yesterday, it was a move of more than 7 basis points higher for the 10-year, about 10 basis points for the front end, with no discernible news. Perhaps it was the supply question coming back into the fore with $24 billion worth of corporate debt pricing. That's something that this market needs to absorb. And today kicks off 3 days of auctions for this bond market. Aussie falling versus the dollar more than 1% after, yes, a hike from the RBA, but the minutes did not talk about the next hike, disappointing the Aussie bulls. Finally, crude, that's down by about 2%. We're oscillating between the supply cuts coming from Saudi and Russia, lifting this oil market, and fears of demand in the case of today, downing it. We're below $80 a barrel when it comes to NYMEX crude. Now, Manis, speaking of demand, you mentioned the slews, so I, of course, have to get into it for our radio listening audience. I do have a chart showing the demand for loans of corporations. Manis, it was tighter, but it wasn't as bad as we expected. We thought maybe it would be really bad considering Jay Powell was pretty dovish. Did he know something we didn't? Well, maybe not, because the results are that 30% of large cap firms reported weaker loan demand. That's better than last quarter. Last quarter, it was more than 50%. So sure, Manis, it's tighter, but there does seem to be some resilience in these figures.
Yeah, well, I mean, look, right up until now, the consumer has been the bulwark, hasn't it? If you look at the other side of that slews report, and we talked about this morning, you've got the corporate side, I've got the consumer side. And on the consumer side, it is tightening. There's a tightening of consumer credit, albeit perhaps at lower FICO scores, but they are less willing. The consumer is now less willing to use credit to burn their way through the spend. So as we come towards this dissipation of savings, we come towards those pandemic stimulus checks are long gone in the history books. It could be the cracks in the consumer that come to bear. Danny, let's talk about one of our top stories. It is UBS. The stock's rising this morning. This as the bank reports that expenses were lower than expected, despite the takeover of Credit Suisse dragging on its performance. Let's get to Zurich. Guy Johnson is on tour there, Guy. So it's the first quarterly loss in 6 years, Guy. What do you think the top line here is? Is it about net new money flowing into the newly constructed institution? Is that about confidence in the new organization? Guy, good morning.
Manis, good morning. It's about stabilization. It's about the fact that progress is being made. It's about the fact that they're sticking to their 2026 targets. It's basically the fact that everything's on track. And I think that's what really the market was looking for here. Just a quick update on what is going on. This is the first full quarter that we've seen these two institutions together. These are unbelievably messy numbers that we're getting out. Basically, you've got UBS making a profit, Credit Suisse making a loss. One outweighs the other, but I think largely you can ignore that number. What is going on here is signs of stabilization in terms of clients. That's really important, and progress being made on the integration. It is going to be a difficult process. The key questions now going forward are, can they keep the people that they need? They're putting money aside to make that happen. What's happening in terms of people leaving the bank, the key people that they need leaving the bank? What's happening with the IT integration? Manis, Danny, pretty soon, the next set of numbers, the full year numbers, we're going to get the big update, the big strategy. These numbers here are kind of a bridge to that setup. And the fact that there are no nasty surprises is good news. That's why the market, I think, is doing what it's doing today.
Yeah, I mean, hey, I wouldn't mind being part of a group, Manis. I don't think, Manis, you'd mind being part of a group that got $50 million to be retained. I wish someone would spend that on me.
Yeah, $500 million. That's what we're spending to keep Guy Johnson on Bahnhofstrasse. It's retention. $500 million to keep the key capital. It's a pretty important part of the transition, though, Guy, isn't it?
It is absolutely critical, Manis, and you have seen defections. Is that process slowing down? Is that 500 million? That's not just for one person. That's for a group of people. They're key people. Is that working? Is that having the effect? Are those defections starting to slow? And that's really critical. Relationship managers are the bread and butter of this business. The wealth management business is core to what they're trying to do next. They need to keep these people. Banks are ultimately about people. The IT systems are also critical as well. Remember, they're turning off effectively the Credit Suisse system and sticking with the UBS system. How's that process going? I think just the takeaway from today is really messy set of numbers. There are no comparisons you can make with any other quarter. So kind of the estimates I don't think are particularly useful. But the fact they're talking about an acceleration of the process, the fact that the process is on track, the fact that they're sticking to the 2026 guidance, that is kind of all the market really needed today. This is going to be a long, drawn-out process. There are going to be plenty of opportunities for slip-ups. This quarter has not delivered any major ones.
Hey, Guy, thank you very much reporting for us there in Zurich on UBS, Guy Johnson. Now let's get to some of the other top stories that we're keeping track of on the terminal this morning. Manus, WeWork has filed for bankruptcy after struggling to recover from the pandemic and a failed public offering in 2019. The company listed both assets and liabilities of $10 to $50 billion in a Chapter 11 filing. WeWork underwent a sweeping debt restructuring earlier this year that said in August there was substantial doubt over its ability to continue operations.
Well, Shein is said to be targeting a valuation of as much as $90 billion. That's the fast fashion giant laying the groundwork for an eventual US IPO. The timing of the share sale remains uncertain given the market volatility.
And Citadel founder Ken Griffin says global investors can't ignore China. Griffin spoke earlier at a finance summit in Hong Kong.
There's much more innovation outside of the United States relative to 50 years ago. This morning I was with one of the prominent Chinese business leaders. The management teams in China are extraordinarily capable. They produce extremely competitive products on the global stage. They lead in many areas that are important to the world: solar, EVs. These are really important competitive advantages that exist in China. Companies, great management teams, great products. If you're a global investor, you've got to be watching and investing here in China.
A big call there, but then they are all on the ground in Hong Kong. So you would expect a pretty robust message there. Let's turn back to the markets because the latest stock market rally running out of a little bit of puff alongside the hopes of a speedy Fed rate cut. Minneapolis Fed president told the Wall Street Journal that he's not convinced that rate hikes are over, showing concerns about inflation ticking back up again. For more, let's get to our cross-asset strategist, Ven Ram. Last week, we had Nat Alliance telling Danny and I the Fed was done, done, done. And here is Neil Kashkari killing the bulls softly. Good morning. Good afternoon.
Good morning, Manus. He's saying done, not done, not done, not done. And that message is what is feeding through to the markets, right? I mean, I don't think that the Fed is in any mindset to raise rates anytime soon, but I think what they do not want is premature positioning for rate cuts. When the Fed came out with what was seen as a very dovish statement last week, the markets interpreted the message as saying, does the Fed know what we don't know, which is, and therefore does it mean a very weak loan officer survey? And that's not what we saw from the survey. We saw that credit demand is still resilient. Of course, the economy is losing momentum, but it's not keeling over just yet. And that means that it's not in the Fed's interest to send yields lower. And that's the message we are getting from Kashkari. And we are seeing nominal yields much higher in tow.
If you look at another major central bank, though, Ven, the RBA, their decision today to hike rates. But the message from them and the reason that Aussie is weakening so much versus the dollar is that bar to hike again seems higher. Despite what Kashkari says, is that not the message from global central banks right now, that if the data is starting to weaken, if they're going to hike again, that bar is really high?
Well, I doubt that reasoning, Danny, for the simple reason, we had RBA standing pat from June, and suddenly they've come out and started raising rates again. Of course, their statement was regarded as dovish today because they said whether they would need to raise rates from going forward. But then, if you look at the rest of the statement that they had, it was pretty hawkish. They are saying that inflation is proving to be a lot more elevated than they expected. It's proving to be a lot more persistent than they expected. and they're expecting the CPI, headline CPI, to average 3% 2 years out. So they're essentially saying for 2 years we are going to miss the inflation target. That doesn't strike me as dovish at all. So we need to be prepared for the markets, for central banks, the major developed markets, banks, central banks to come out and raise rates if necessary. It's not done and dusted yet.
Okay, we can revisit Danny's favorite word, pernicious. Persistent and pernicious.
It is my favorite word.
It is. She does a lot. She does a lot of things. She helps me with a lot of words. She finds the words. I just grab them and I go, "That's the word of the day." Ben, thank you very much.
I'm the vocab book.
Yes, she is. Excel spreadsheets and vocabulary. She'll be helping my diction next. Bloomberg's Ben Ram in Dubai on the markets. Danny, let's stack up what we got for the day. Minneapolis Fed President Neel Kashkari joins the Bloomberg surveillance team at 7:30 a.m. Let's see what he means in terms of his rhetoric.
But first up next on Brief, we're going to be speaking with Emmanuel Ko, head of European equity strategy at Barclays. Manus.
Stay tuned for the Bloomberg New Economy Forum. It gets underway in Singapore. This year's theme is embracing instability. The interviews you don't want to miss. After his numbers, the UBS CEO, Sergio Motti, takes to the platform along with a host of other names in Singapore at the New Economy Forum right here.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
So you told your mother you'd like to go to Africa and see the chimpanzees, and what did she say?
Not the chimpanzees. I would have studied anything.
Well, what did your mother say to anything?
If you really want to do this, you're going to have to work really hard. And if you don't give up, hopefully you find a way.
Right now, it looks like you can get equity-type returns from credit. A little below 10 for what we call liquid credit, stuff that's tradable every day, and well above 10, perhaps, for private credit, which is not tradable. The point is that, 21 months ago, today high-yield bonds yield in the 9s. 21 months ago, they were in the 4s. When they're in the 9s, you can invest in them with high expectations, competitive with equities, and more than sufficient to meet most organizations' needs.
Howard Marks of Oaktree Capital discussing his outlook with Bloomberg on the sidelines of the HKMA Global Financial Leaders Investment Summit. Now, we're more than 80% into earnings season at the moment. It feels a bit like a choose-your-own adventure. The market, for its point, has decided in large part to concentrate on some of the bad results. But I want to show you what sales beats have done. less than half of companies that have reported in the S&P have beat revenue estimates for the third quarter. That's the lowest share since 2019. So is the era of unbridled demand from the consumer over? Or is there something else we should be concentrating on earnings? Let's get to our guest. Joining us now to discuss is Emmanuel Cole, head of European equity strategy at Barclays. Emmanuel, am I right to maybe look at some of this weakened demand coming from earnings, or do you see a different bright spot that makes sense to have the mood music be for this quarter?
Yeah, good morning, Danny. Well, I think we've clearly seen some sign of moderating demand in US and Europe. So as you said, that was the lowest number of beats we had in 2 or 3 years. And the mentions by companies of weaker demand, weaker economy are rising quite significantly. So there is no doubt that growth is slowing, and we are seeing that in much weaker top-line delivery. I think the bright spot maybe that margins are holding up, right? So top line has basically come down, has normalized, but so far we are seeing the bulk of the corporates able to maintain fairly high margin. I suspect pricing must be offsetting some of the volume weakness we are seeing as well. So earnings have been beating estimate, less than before, but earnings are still basically delivering and growing, even though top line seems to be pointing to softer demand ahead.
Well, let's see how that top line continues. Emmanuel, good morning. It's good to see you. I like how you encapsulate the mood music. I want to understand your perception of risk. Last week was one of the best weeks in stocks that we had of 2023. But I look at what you say. We are bruised but not broken. The mood has turned decidedly risk off, with surging real rates, a higher dollar, mixed earnings, and a messy geopolitics hurting risk assets. But the sell-off in stocks is somewhat ahead of the moves in credit and earnings. However, the technicals are closer to oversold than overbought. So we're bruised but not broken. Does this mean we're putting in some kind of a base level maybe earlier in the US than we are in Europe?
Yeah, man, I think, look, you had a combination of risk-off event that, put together, hurt the market and, took market down pretty much 10% from the summer highs. And, we see a lot of, we saw some sign of capitulation, a lot of negativity in the markets. And, to some extent, our view and what you mentioned was written like a week ago before the big rally in the market. But our view was, look, it might not take much for the market to form a trading bottom. And I think that the first condition for stock to stabilize is some relief on the rate side. We need to see some stability in rates, I think, for the equity market to find the floor. And look, we do believe that peak rates are in sight. We don't think we are completely done with central banks. We think the Fed might hike one more time in January, for example. The data dependency means that it's going to be very hard to get some insights from central banks for good. But, broadly speaking, we've seen rates going from 0 to 5% in the US. Most of the central banks are done with hiking rate, and that might come with a bit more stability in rates, hence help equities to form a bottom.
I'd assume that it'll take a while to really say, okay, we're stable now. We've gotten to that point because we thought we've been there before. I mean, yesterday we have someone like Kashkari coming out and saying we need to do more work. I'd rather over-tighten than under-tighten. So what happens in the meantime as we get glimmers of hope, false or not, like we did last week, that we have reached the end of the cycle? Is it just volatility from here on out?
Yeah, I think it's going to be volatility. And again, the point of being data dependent, it means central banks cannot really give some precise forward guidance from here. So, it's going to be a bit of a guess, game for the market. I mean, look, you had a significant easing in financial condition last week. Dollar was down, rates went down, equities went up. I'm not sure this is what the Fed wants. And the market is now pricing in pretty much 4 cuts by the Fed starting in May. And there is no way the Fed will accept that. So I would expect a bit of pushback on this, repricing of lower rate by the market. You have a lot of Fed speak this week, so I would expect maybe, rates volatility to resume and, that to be a bit of credit check for the market. But broadly speaking, I think we are swapping, rates or rising rates for slowing growth. And as we know, on 6-12 months horizon, if growth is slowing, I don't think rates will be the #1 concern for the market.
Right. Yeah, but we still have quasi-QE because if you look at what the Treasury's actually got to issue to pay, if you look at the amount of bonds they've got to issue just to pay the interest on the debt. So it's a battle royal between the Treasury and the Fed. But I'll leave you with that thought. Thanks for coming in. Hopefully the bottom is in. Emmanuel Cole, his thoughts from Barclays this morning on Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Next week on AI IRL.
It's talent that drives, this innovation, and talent still concentrates around a small number of physical places. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities, but that is going to take 5 years or so. The export controls that the US has implemented, are real.
This is Bloomberg Brief. I'm Danny Berger in London with Manus Cranny in New York. Manus, a few hours ago, we got the Saudi Aramco earnings, of course, the world's biggest crude exporter. Two different threads here. One, net income did drop 23%, but at the same time, they've held on to this chunky $29 billion dividend.
Yeah, and the reason why that's so important, Danny, I mean, by the way, this is not a hugely owned stock because so very little of it was IPO. There's lots of chatter that the Saudis may go for another IPO, but it is one of the world's biggest crude exporters. The upstream business, Danny, including gas and oil output, that dropped by 23%. But of course, they've cut, Saudi Arabia has unilaterally cut the amount of oil they're putting out onto the market, but it's all about the futuristic projects for Mohammed bin Salman. The more Aramco produces and money and dividends goes into the PIF, goes into the mega projects. Danny.
Yeah, buying the Neymars, the Ronaldos of the world. You could probably afford a lot of Rolexes with that. At least someone out there apparently is going to be buying a lot of Rolexes. Manus, there was also Watches of Switzerland earnings. How's this for demand? They said that by 2028, they will double sales and double profit. Of course, the majority of what Watches of Switzerland sells are Rolexes.
Yeah, I mean, look, there was a monster rally, wasn't there? There was a supply shortage. Every time I went through Dubai Airport, I'd do a little video of the Rolex stand, and it was empty. It was like a barren desert of Rolexes.
Tragedy.
It was tragedy in itself. I don't wear a Rolex myself, but I'll leave you with that thought. I'm open to Thanksgiving gifts, Ms. Berger. Good morning.
Oof. Good luck with that.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
in destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. UBS posts its first quarterly loss in almost 6 years. The ongoing integration of Credit Suisse drags on performance, but shares rally as client inflows and progress in meeting cost-saving goals. Fresh doubts emerge whether the Fed has finished tightening. Neil Kashkari says the fight against inflation, it isn't over yet. And Aramco maintains its payout to the Saudi government and investors at more than $29 billion, despite third quarter net income dropping by almost a quarter. It's been some extreme whiplash in this bond market. We are rallying. 10-year yields are dropping by 5 basis points. That's what we saw all last week. But yesterday, Manus, it was a really unusual sell-off. Perhaps it was the supply of corporate debt, $24 billion of worth that came to market. We saw 10-year yields drop by about 7 basis point rise by 7 basis point front end did even worse. Now, when other central banks speak, RBA had their decision this morning. They hiked, but it's widely been regarded as a dovish hike. There was no outline for the next one to come. Aussie drops by about 1% versus the dollar. And finally, NYMEX crude. Talk about another volatile asset. Perhaps it's the demand concerns coming into the fore today, Manus. We had crude falling by more than 2% this morning. It's below $80 a barrel for WTI, despite the fact that it had been supply cuts that have really been holding up this market. And you and I were just talking about Saudi Aramco's earnings, which also underline this idea that, yes, Manus, they are continuing to hold on to that production supply cut.
Yep, certainly a lot of volatility there, but $64 billion worth more of supply is to come in 10s and 30-year bonds. So that indigestion of the bond market may indeed come to bear. Equities this morning are a little bit lighter. Were they broken? Were they pushed a little bit lower by Neil Kashkari, who will be with Bloomberg a little bit later on, saying he'd prefer to over-tighten than do too little. So that's about stacking it high. It's sort of like front-run yourself. Over-tighten, and then we can talk about policy error. So let's see what Kashkari really means by that. Stocks are just a little bit lighter on their feet. We've still got a host of people, Kalanovic saying this is a knee-jerk reaction, the best week that we had of 2023 last week. When it comes to the NASDAQ, down by an eighth of 1%. Again, the momentum is really in the underbelly of the U.S. economy in the Russell 2000. We have gone 500 days without a record high on the Russell. The SLU's report, the lending officers report, I think Danny tells a lot. There's a tightening in the consumer credit, and they are less willing to rely on credit to give that support. A couple of stocks to keep an eye on. We're going to talk a little bit more about UBS. First loss since 2017, but the inflow of money is there. Stock is up 4%. And Watches of Switzerland, that second-hand market is going to be one of the prime drivers for Watches of Switzerland. Stock is up 10%. That is the leader on the Stock 600 this morning. Danny.
Manus, there is a picture that seems to be accumulating of weaker demand. You mentioned it in the slews when it comes to the consumer, but we're also speaking to Emmanuel Cole of Barclays about this, that companies are also reporting weaker demand, but the head-scratching thing is that margins are holding up. They're still having high prices. I mean, surely those two things can't continue to coexist forever on out.
No, well, there's this divergence, isn't there, between the corporate chart that you showed earlier. In other words, yes, lending is getting a bit tighter, things are getting a bit hotter, but it wasn't as bad as everybody had anticipated. Go back to Emmanuel Cole, and the whole point that he makes is this, which is for these markets to find stability, you're gonna have to find stability in the rates market, and that is something that the market is still very unsure of. He said one more hike probably at the start of next year, but UBS is certainly in focus.
Yeah, I mean, those shares keep extending their gains, Manus. The bank had a lower than expected expenses, overshadowed its first quarterly loss in almost 6 years. Let's talk about the details. Joining us now is Allison Williams of Bloomberg Intelligence, who's been, Allison, I'm not sure if you got up early or stayed up all night to follow these earnings, but we thank you for being here with us. It was a really messy quarter, and it's kind of difficult to come away with a clear narrative. What narrative did you come away with through these numbers of the integrated, now giant Swiss bank?
I think the number one thing that we saw was that steadying of the deposit inflows at UBS, but especially Credit Suisse. And actually, if you dig into the numbers a little bit, you saw that actually momentum accelerated in September. So we think that was the key positive. And it was in the wealth business. It was in specifically the wealth deposits. That was the key point of pressure that led to this deal. And also inflows into the Swiss unit, while UBS is also holding up well. So the rest of it is, as you said, very messy. So we did see about $2 billion of integration costs. We're going to see another $1 billion next quarter. We do think it's positive that they're accelerating the wind down in the non-core unit, managing down those risk-weighted assets. And I think the big news will come next quarter when we get the strategic plan, the 3-year plan.
Allison, good to see you this morning. I just want to focus a little bit more on the integration, because we hear incremental closing down the investment banking business, let's say in Spain, there's headcount reductions there. But this is very much his style. He's been through this reorganization process before. I get the sense that Motti and the team are front-loading the pain trade for investors. In other words, it's going to be $3 billion before the end of the year. The pain isn't done there. So he's actually front-loading a lot of the bad news. And from history, and having spoken to him a number of times, this is about get it out there, get it done, get the worst case scenario in everybody's mind, and if I can do a little bit better than that, I will.
Yeah, and keep in mind that he is integrating two globally systemically important banks. That's something we've never seen before. It's certainly something we never expected to see. Imagine the complexity across these two institutions and really bringing them together. I think, the initial days are really just sorting it out. What is going to be core, what's going to be non-core, right? So we saw a lot being moved into the non-core unit. Credit Suisse had actually started to do this a little bit, and UBS really sort of accelerating that, and then talking about taking the opportunities to really offload what they can in that non-core business. And I think next quarter is going to be the same thing, right? It's going to be another very messy quarter, but as you said, the quicker you can be more aggressive and get in there and get things done, to clear the decks and make the way for the core business and really set the path in January or early February, whenever they report their fourth quarter results.
Allison, it's interesting because we're also in this period where we had talked about the talent war being over, but you look at banks that are having their moment in the headlines that need to hold on to talent. Goldman, to be specific, and in this case, UBS. $500 million of retention payments to key Credit Suisse staff. Can you put that into context of just how big of a figure that is in terms of contributing to overall costs for UBS?
Well, I think that certainly it does contribute to the cost. As I said, there was $2 billion in integration costs alone in the quarter, so you can think about the $500 million in the context of that number. But really, that's about retaining revenue, right? And as we know, we talked a lot about assets, but there's also the core talent. And so the bank really does need to retain that talent to think about not just the cost side of things, but the revenue side of things going forward. It's positive that we're seeing some of the client assets coming back, and we're seeing the wealth flows, but we also do want to make sure that the talent that is bringing in those flows, managing those assets, as well as in the investment bank, where, by the way, M&A was one of the big positives we saw this quarter. M&A and the U.S. investment banking business are sort of two of the bright spots that UBS is hoping to leverage from Credit Suisse, and they are going to want to retain those bankers, especially in such a period of uncertainty.
Yeah, the investment bank was up 36% compared with last year, and it was fees on the deal making. Part of the entire thesis of why you ever owned UBS, let's say relative to some of the other major players in Europe, was dividend. The price to book value of this bank is exceptional relative to its peers. How much of a re-rating do you think suppression there is because of the lack of dividend and the lack of buyback, which are two of the things that they're holding on to because they're integrating two systemically important banks? How important is buyback dividend narrative to the UBS 2024 narrative?
Well, I think it'll be important for them to keep paying out the dividend.
Yeah.
The buyback, however, and I think this is actually something that's working in their favor. During the pandemic, the most recent crisis, UBS had said, look, we're going to think about our payout more holistically, pay out a dividend, but move more towards buybacks where we can be more flexible. And that is paying off for them, right? Because they do have that added flexibility. And so there is going to be a pause for buybacks. But if you think about some of the U.S. peers where UBS generally will compare themselves, the U.S. peers are also holding off because they have Basel III Endgame. So a bit of a different story. But I would say from an investment perspective, their buyback, their total capital return is a bit held back, but that tends to be a common story.
Allison, just to wrap things up, you mentioned that it's going to be the next earnings report that we maybe figure out the bombshells, the big picture things that we want to know. What is going to be the message that this market needs to hear from Armati in 3 months' time when they can give more details on the integration?
I think it's going to be tough, right? Because I think that this is a story that's going to require patience, and it's going to have to play out over time. I think what Armati is going to have to do is to set targets that are both reasonable, that can be achieved, but also have enough upside enough to get investors interested. And I think to lay out a clear path, and the most important thing from there is going to be lay out a path that the bank knows that they can meet or beat, because it will be such a long journey.
Okay, Alison, thank you so much for being with us. Let's see what the grand plan is, and we will hear from Armati later on this week at the New Economy Forum. Alison Williams, the Bloomberg Intelligence, burning the late night oil. For a quick snapshot of what's going on with the banks this morning, UBS is actually up by 3.75%, the first quarterly loss in 6 years, but they are winning the hearts, the minds, and the money of the billionaires. There's a nice inflow there. Barclays up flat on the day, and HSBC just by 0.2%. Danny.
And it's turning back to the central banks, hopes of a speedy interest rate cuts were dampened yesterday by Neil Kashkari saying it's too soon to declare victory on inflation. Now, Bloomberg also spoke exclusively to Oaktree Capital co-founder and co-chairman Howard Marks on how high he thinks rates will go.
I think that rates may go a little higher, but not terribly much higher, or not. There's substantial progress being made against inflation, and that's what matters. The economy is producing mixed signals, but at least inflation is well down from the peak, and things are performing well. So I would say that maybe a little higher or maybe not.
You've been known not to give your macro forecast,
right?
Although very recently you've made something similar, which is the thesis is that the sea change has come,
yes,
and that the next 10 years will be very different.
Very different from the last.
Yeah, and underscore the premise there. And what do I do with that information?
Well, if you came into this business since 1980, which covers almost everybody, you've only seen either declining interest rates or ultra-low interest rates. you have to go back into the 70s to have seen a different climate, which I fortunately did do. I believe that this monotonic decline of interest rates is over. Number one, there's not much room for a further decline. And number two, I think the Fed probably understands that it kept rates too low too long and that there was a negative consequence, certainly in terms of inflation. So, I think the important thing is that, and I said in my memo Sea Change, which was published in December, that I don't believe in forecasts, especially my own. But I'm willing to say that for the next decade, the Fed funds rate is more likely to be between 2 and 4 than between 0 and 2. That's as far as I can go. But and I only say that directionally to indicate my belief that the period of ultra low rates is over.
Our exclusive interview there with the Oak Tree Capital's Howard Marks. Coming up on the show, President Biden and Prime Minister Netanyahu discuss the possibility of a pause as the U.S. faces increasing outrage for holding back from calling for a ceasefire. That's next. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Well, there will be no ceasefire, general ceasefire in Gaza without the release of our hostages. As far as tactical little pauses, an hour here, an hour there, we've had them before. I suppose we'll check the circumstances in order to enable goods, humanitarian goods to come in, or our hostages, individual hostages to leave. But I don't think there's going to be a general ceasefire.
Tactical little pauses, but no ceasefire. The Israeli Prime Minister Benjamin Netanyahu there. Joining us for the latest analysis is Bloomberg's Ros Matheson. Ros, good to have you with us. What more do we know about this call we understand between Netanyahu and President Biden? Do you think Netanyahu is now listening to a shift in tone from the White House? Good morning.
Thank you. Good morning. Yeah, well, certainly we've seen a number of conversations now between the US president and Netanyahu since the war broke out, and there has been potentially a shift in tone, not just from the US president, but also from the US Secretary of State, who was just recently in the region again, having a blizzard of meetings with Israel and other nations. And that's that escalating sort of statement of concern around the humanitarian situation in Gaza itself, and pressing Israel for these pauses in the fighting. I mean, you heard Netanyahu calling them tactical little pauses, so very, very brief indeed. We're only talking a matter of hours to allow perhaps some aid to get in for people to relocate further to the south. So this is not a comprehensive stop in the fighting or anything towards a ceasefire, but you are getting the US more publicly saying, you know, they're highly concerned about the situation on the ground in Gaza.
And what is the latest on the ground in Gaza?
Well, certainly we've got Israel troops encircling Gaza City, which is the densely populated centre in the north, starting to push further into the city, and that's raising the prospect what we're going to get in the coming days and weeks is street-to-street, door-to-door combat between Hamas forces and Israeli soldiers. And in that environment, the fighting is going to be very, very slow. The casualty rate is probably going to go up, not just for the soldiers, but also for civilians who are still very much in that densely populated area. But again, the Israelis are saying they're there for weeks, if not months. This war is going to go on, and they are going bit by bit. But certainly they seem to be wanting to take over Gaza City and then essentially sever the north of Gaza from the south.
And of course, the rhetoric around how to deal with this changes on a weekly basis. But in terms of deployment to the region, the Pentagon has announced that it's deployed the USS Florida attack submarine to the Persian Gulf. So tell us a little bit more about the significance of that submarine being in the region.
Well, that's right. It's actually a nuclear-powered but not nuclear-armed submarine. It carries cruise missiles, so it's less of an attack submarine than one that can send long-range missiles in if needed. But it comes against that backdrop of the broader build-up of US military forces in the region. The US has announced several times it's sending more troops into the Middle East as a whole. We know that its troops based in Iraq and Syria, for example, are becoming under regular attack, drone attack from places including, you know, Iran-backed forces in Syria and also in Yemen and so on. And so you're seeing bit by bit the possibility of the US being drawn in militarily to this conflict. That's something that the US clearly does not want to happen, but with such a strong military presence in the region, it does raise the possibility at some point that they do get pulled in.
Roz, thank you very much for joining us this morning. That is Bloomberg's Rosalind Matheson. Now, coming up, we're going to take a look at some of the market-moving events you need to know to get your day started. And a quick check on markets, as probably most of you have already started your day if you're watching Brief this morning. S&P 500 futures struggle to find their footing after just barely eking out a rally. Dollar remains strong, putting pressure on crude, down nearly 2% as 10-years rally after yesterday's sell-off. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to Bloomberg Brief. Danny Berger in London, Manish Cranny in New York. Let's get you set up for your trading day with a look at what's ahead over the next 24 hours. It's a host of Fed speak that's going to be coming out throughout the day. Barr, Schmidt, Waller, Williams, and Logan all on deck. Plus, don't miss our interview with Minneapolis Fed President Neil Kashkari. That's at 7:30 a.m. Eastern. And we'll get earnings from Uber before the market open, then eBay and Occidental Petroleum. Manus, all of that will hit after the market close.
Well, let's have a look at TripAdvisor because we've got their third quarter adjusted earnings per share. That beat estimates. They had a nice broad range of narrative for the market. The stock is up pre-market. At one juncture was up 11%. It is about restructuring. Various analysts have come out with their notes. They talk about a diversified earnings beat. There you go. TripAdvisor up 10.8%. Revenge tourism lives large, lives long, and prosper. KKR, you like a bit of KKR, don't you?
I do. I also like traveling too. So yeah, sure. All of my favorite things. KKR, they're going to report earnings before the bell. Something that also might be helping them out here, Manus. Just out, Abu Dhabi's $1 trillion fund is going to be joining them for that Telecom Italia bid.
Do you know that in 5 years, 6 years living in the Middle East, Adia never did an interview. They're one of the most discreet. There's only one person within Adia is allowed to sort of go out and speak publicly at various events. So it is probably one of the most closed information silos. It's a beautiful tower in Abu Dhabi, but of course, there's one man who manages everything. Sheikh Tahnoon now has sort of a great deal of power over many things in Abu Dhabi. So that grid deal is going to be interesting. Adia and KKR.
Yeah, well, at least KKR speak to us. So, I mean, their offices aren't as pretty. So, I mean, there's that. Manus, we're also going to get some earnings before the bell today, too, though.
Indeed. We're going to get Uber. I'm using them regularly. Don't worry. I'm helping them. Apparently, I get 5 stars back. I give 5 stars to everybody. Occidental comes out after the market close as well. And, of course, we had those banging numbers from Saudi Aramco. But it is going to come down to supply of bonds. What level of indigestion will the bond market have? We're going to catch up with the Hoisington chief strategist, Lacey Hunt. That's a little bit later on. But there are your bond yields. As you said at the start of the show, it was a bit of a whiplash day, wasn't it, yesterday? But it's all about supply.
It was, and this is the remarkable thing about the rally last week. It's almost like we forgot about the threat of supply. Well, Manus, it came back into the fore yesterday, $24 billion worth of corporate bond issuance, and we have a pretty difficult issuance schedule for this week.
We've got $40 billion of 10s on Wednesdays, $24 billion of 30s on Thursdays. But there's T-bills tonight, I think you said. There's a little bit of bill auction.
Yeah, 3-year notes are going to be on offer today. I mean, bonds are rallying for today, but can it hold up with, as you say, the indigestion of supply?
capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg.
There's a little shift underway here that I think we want to be mindful of.
We could see some positive action through the end of the year.
The heightened macro uncertainty means that investors do need to be nimble.
We don't think we're getting any more rate hikes from the Fed.
It's far too early to be talking about easing, so just beware of that sting in the tail.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market this morning pulling back by 0.2%, but what a rally over the last week or so. 6-day winning streak on the S&P 500. Make it 7 on the NASDAQ 100. Bramo, over that period, the NASDAQ 100 up by more than 7%.
So here's the question. Is it durable? We were talking about this yesterday, and everyone was saying it really comes down to whether we get some sort of stability in yields. Clearly, there is a feeling of unease that we got yesterday from that, and some Fed officials have been pushing back, including one who we're going to speak to today. I'm just saying, are we going to hear more of that coming up?
Neil Kashkari in about 90 minutes' time of the Minneapolis Federal Reserve. Too early, too soon to declare victory.
How much is he pushing back, basically seeing the easing in financial conditions off of what Jay Powell said and saying, you know, we'd rather err on the side of over-tightening than under-tightening. At a certain point, who matters? Does Neil Kashkari matter more than Fed Chair Jay Powell? Is this going to be a game of basically chicken, or is there something material here, as we heard from Citigroup's Andrew Hollenhorst, doubling down on the reaccelerating inflation kind of story?
Let's get to the pushback. Morgan Stanley, the pushback, JP Morgan, Mike Wilson over at Morgan Stanley. We find it difficult to get more excited about a year-end rally. Marko Kolanovic over at JP Morgan, falling bond yields, dovish central banks, quote, knee-jerk positive for equities in the short term, but the growth policy trade-off will remain challenging into year-end. That's the view from Morgan Stanley and JP Morgan this morning.
Problem is they've been wrong. They've been wrong all year. And this is really the problem when you've got investors who have gone into equities despite some of these warnings and have made bank. So at a certain point, you have to think, okay, if the companies are delivering and the earnings now are good, yeah, we've got no visibility until later, but hey, you better dance while the music's playing. And that, from all of the notes that I'm reading this morning and many of our guests coming up, seem to be saying just
What
that.
if I told you could be wrong, really wrong, and still bank hundreds of millions of dollars? We work.
The wrong business.
We work. At its peak, 2019, here's a company that gets valued in private markets at what, 47 billion. And here we are 4 years later and the company's filing for bankruptcy. And in the meantime, we know based on reports that Adam Neumann, the founder of the company, has managed to take in hundreds and hundreds of millions of dollars. Bramo, that's unreal.
There's the question of how much he personally has profited. And then there's a question of how many broken business models are there out there that grew up during the pandemic with the executives taking in massive salaries while spending more than $1 for every dollar they took in because they counted on a free piggy bank that was the debt market that no longer exists. This, to me, is the question. We expected to see more of this. He might be the prime poster child for this, but we expected to see more of this at a time where you've got a company that locked in at 10 to 20-year leases and then said, you know what, you can come here for a month at a time, pay us a salary, and we'll give you free beer and a ping pong table. So, I mean, at what point do you start saying this is an anomaly versus something that has maybe some indications of what's to come?
Are you suggesting he failed to elevate the world's consciousness? Is that what you're suggesting this morning? I'd make 2 points on this. I'd make 2 points. One, you're raising the right question. Have we fully realised the pain associated with taking interest rates from 0 through 5%? No. There's still more pain to come. It's going to come to the surface. We'll see it in different places. 2, we should do a special on the winners of ZERB. We should do a special on that, a full programme, who won ZERB. Adam Newman's got to be a major candidate for winning that era.
I think there are a lot of people who are candidates. You just look at the stocks that are parabolic in the opposite direction during the pandemic, and you think, okay, who was bloated during an impression of another era? And who used this money to basically invest heavily with all of these ideals? And then, you know, I'm thinking of Peloton, for example. But Peloton, I'm not thinking, you know, there are a number of them, right, that came out with highfalutin concepts that drove their borrowing binges and didn't really drive profits.
We should do this special, shouldn't we?
I think that's
just like
really
a nice
fun.
Christmas special. It'd be a good thing to do. Equity futures right now on the S&P 500, negative by 0.2%. Big run in this equity market, 6 days on the S&P 500. Longest daily winning streak since the middle of June. Yesterday, bond yields actually higher, and equities did okay. This morning, they're lower by 5 basis points. Your yield on a 10-year here, Lisa, 459.34.
I love that yields can go up or down 9 basis points, and it's just a mild move at this point. Today, we get a host of Fed speak, including the Fed Governor Chris Waller, as well as Vice Chair for Supervision Michael Barr. We also hear from Fed presidents from Chicago, Kansas City, New York, Dallas, and, of course, Minneapolis Fed President Neil Kashkari. He is speaking to us and Michael McKee at 7:30 a.m. Eastern Time here on Bloomberg Television, Bloomberg Surveillance. Again, I want to know how far he's going to push back against some of the enthusiasm that we're seeing in the market. We expected this to happen, and pretty much on cue, he came out yesterday.
Are there reasons for this Federal Reserve to be more tolerant of easing financial conditions, given that we've got a little bit of a rebalancing taking place in the labour market, unemployment shifting a little bit higher, wage growth a little bit more subdued? Neil Dutta of Renaissance Macro says yes. That's going to be a question a little bit later.
Surgical cuts. We can talk
all
about
that's Neil's phrase,
cuts, with Neil later. The surgical sales, I'm curious about this. 1 p.m., U.S. Treasury is selling $48 billion of 3-year notes at a time, where the Treasury Department is really going to be front-loading a lot of these sales. We had 3 straight very bad auctions in a recent slate of auctions, which is the first time, or one of the first times that's happened since 2011. Do we see something different in this week? And today is election day, so if your kids go to public school, they're not in school today. Good luck with that. There is a question about whether these are relevant in any way, maybe the idea of social issues. What I'm personally interested is in what's going on in Virginia. Glenn Youngkin, who is a potential Republican nominee for the presidential election, is trying to flip the Senate in Virginia to Republican to get a sweep. So currently the House is Republican. If he can get that, there are going to be a lot of calls for him to run instead of President Trump, former President Trump.
It's amazing we're talking about potential nominees for an election that's less than 12 months away.
That's
for people who aren't even running. We're still playing that game.
I mean, anecdotally, is he not going to pseudo fundraisers with big people with big pocketbooks on Wall Street who would love for him to run? So let's see if he can come through on it.
Mohammed Yunus of Gallup's coming up on the program in about 15 minutes' time. Mohammed Yunus of Gallup is going to basically tell you how deeply unpopular both parties are with the electorate, and how many candidates are also deeply unpopular with the electorate. And I'm talking about the former president and the current president as well.
Nobody wants that election, and yet that seems to be the election that we have. So we're running out of room, as you point out. We're running out of room for other people to come in. So is this going to be the moment? I think that's what people are looking at. If he does get a clean sweep in the House and the Senate, turning to the GOP in a very blue state, or in a very purple state, I should say, do you end up with a lot of calls for Glenn Youngkin to be the Republican presidential candidate?
That conversation with Mohammed Yunus about 10 minutes away. In the next hour, we'll catch up with Bloomberg's Anne-Marie. Joining us now in this market, Ben Laidler, Global Market Strategist at eToro. Ben, good morning, buddy. Great to have you with us as always. I want to start with this one, your words. Grounds for contrarian optimism. After the week's rally we've had, how contrarian is that, Ben, right now?
Oh, I think pretty contrarian. I think the rally you've seen over the last week has basically been short covering. It's basically this very bearish consensus caught completely wrong-footed by this sort of easing vice of bond yields and oil prices, which I think consensus thought was going to the moon. And we've seen that vice now work the other way. We've seen the relief trade. But I think from here, I think that easing vice, the end of the earnings recession, and this good fourth quarter seasonality, which includes still very poor sentiment. A year ahead repositioning rally, I think, is still to come as people refocus on a better 2024 and, throw in the restart of buybacks. I think it's going to be a good fourth quarter.
Ben, I'll ask you the question that we talked about at the top of the hour. Do you think there are reasons for the Fed to be more tolerant of easing financial conditions?
At the margin, but you're not going to hear it from them. They're going to have to walk the talk. They want financial conditions to stay, reasonably tight, to do their work for them. They know that if they give an inch, the market's going to take a mile, as we've seen over the last week or so. So they're going to do what they have to do, but I would take it with a grain of salt.
This is kind of a delicate question, but we were talking at the top of the show about Morgan Stanley, JP Morgan, other strategists who are still bearish on risk assets heading into year end, especially because of weakness to come. Ben, given Wall Street's bearishness, does that make you more bearish or more bullish?
It makes me more bullish at the margin, right? So I think that this poor sentiment that's out there is a significant ingredient of improving the risk reward. And just think about it for a second. This poor sentiment does two things. It means there's a lot of money sitting on the sidelines, which could come into this market if I'm right, things get incrementally better. And secondly, it significantly improves the risk reward. If we get more bad news, it's already priced in. People are already expecting it. And you don't need good news for this market to move higher. You just need less bad news. And we got a huge reminder of that last week. We basically saw the unwinding of 6 weeks of underperformance in 1 week. I think that just showed to a lot of people the risks of being out of this market.
One thing that kind of defies my sense of reasonableness is that people keep talking about the excessive bearishness out there, and yet I'm looking at year-to-date gains on the NASDAQ of 30% and more than 15% on the S&P. It doesn't scream everybody's on the sidelines hiding under a blanket. So at what point do you see this bearishness in full force that you want to push against?
Yeah, so we have an investor sentiment index, which, to your point, is not at the level of sort of maximum bearishness that it was maybe 6-7 months ago, but it's absolutely below average. And in this sort of summer pullback we saw, it became, it fell below average. So, we're focused on the fundamentals. That's what's going to get this market higher. It's not going to be sentiment. That's the sort of icing on the cake. What we're focused on here is I think we've seen the top for bond yields. I don't think we're going to see oil sustainably above $90. We've had the end of the US earnings recession. And over the next few months, we're going to get clearer visibility on the Fed getting ready to cut interest rates. I think the Fed put is back. The economy is going to slow, but I think earnings are going to be resilient to that. And we're going to be discounting the Fed cuts that are coming. That's the bullish case for 2024. And I think people are going to start buying into that, or at least trimming these negative bets as we get closer to the end of the year.
Ben, that's not the bull case, that's the bull dream. The Fed puts back. Let's unpack that. Why do you think the Fed puts back?
Core inflation's at 4%, PPI is half that. What's the insurance policy for markets is if we get that hard landing, which I don't expect, but if we do, and that's the market fear because it's going to drag earnings with it, I think it'll also, it'll pull inflation down. And I think inflation is close enough that if you get that, the Fed can start cutting interest rates.
Okay,
and this is a huge difference from even 6 months ago, where if the economy had fallen off a cliff, the Fed's hands were tied. They're not tied anymore.
The Fed put traditionally was, in the sign of any weakness, the Fed had carte blanche to cut rates and to basically stimulate the economy. You're saying that the bar to cut rates has been lowered materially over the last, say, couple of weeks. Is that what I'm hearing from you?
No, it's been lowered materially over the last few months. 6 months ago, if the economy had fallen off a cliff, the Fed's hands were tied. It couldn't cut rates. Now it can. And I think that's a big difference. If you're a bullish investor like me, that's your insurance policy. But they're not being a soft landing, and for me, getting the economy completely wrong. I now have the Fed standing behind me. They weren't standing behind me 6 months ago.
Ben, when you say cuts, cut back to what? What kind of levels are you thinking about? There's a lot of people in fixed income having that debate, and they really can't figure it out. Where are you on that debate?
I mean, inflation's not where it needs to be yet. Obviously, if the economy cools, it'll come down a bit faster. I don't think we're looking for, dramatic cuts. But I don't think the world has completely changed from, you were talking about ZIRP earlier on. A lot of the structural drivers of that, whether it's debt, whether it's demographics, whether it's technology, they haven't gone anywhere. They're still there. So I don't completely discount it.
Ben Laidler of eToro. Ben, a lot to think about. We'll do that through the next couple of hours on this programme. Ben, appreciate it. What's changed between now and ZIRP? We can have that conversation. What's changed between now and last week? 2 weeks ago. 2 weeks ago, we're north of 5% on a 10-year yield, and we're talking about budget deficits, yield curve control at the BOJ, a lack of predictable buyers in the Treasury market, a loss of that in places like China, central banks, QT, the ECB, the Federal Reserve, all of that. And here we are sitting here saying with conviction that I think we've seen the highs in bond yields.
What's changed, in my opinion, is that the excessive short positions on treasuries have basically been washed out, and we saw some repositioning there. The Treasury Department came out and threw the market a bone and said that we're not going to issue an incredible amount on the long end of the curve. We're going to really focus our issuance on the short end. And the Fed came out and wasn't that hawkish. And that was basically the insurance policy that the bulls are looking for, that they hold in their hands.
They are chewing hard on that bone. Let's put it that way.
Getting its use.
Equity futures on the S&P, negative 0.25%. Next hour, 90 minutes away. Neil Kashkari of the Minneapolis Federal Reserve, live from New York City this morning. Good morning.
Is on site. Live from Washington, Kaylee Lyon speaks with Grayscale CEO Michael Sonnenschein and others. Tune in for a special one-hour episode of Bloomberg Crypto. Bloomberg. Context changes everything. The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
It's DC FinTech Week, and Bloomberg is on site. Live from Washington, Kaylee Lyon speaks with Grayscale CEO Michael Sonnenschein and others. Tune in for a special one-hour episode of Bloomberg Crypto. Bloomberg. Context changes everything.
We're announcing historic investment in America's railroads. I've been talking about this for a long time, I know. But finally we're getting it done. More than $16 billion, 16 with a B, billion dollars here in the Northeast part. Folks, too many people have been left behind in the past or treated like they're invisible. We're building an economy from the middle out and the bottom up, where no one's left behind.
President Biden in Delaware announcing $16 billion, with a B, in new funding for passenger rails. This all ahead of the 24 elections, where a recent New York Times poll has the president trending Donald Trump in 5 key swing states. Do you know what the Amtrak shtick is about? Because I don't get it. I don't know anyone that loves Amtrak, apart from the sitting president.
Yeah, I've got it.
You can't explain that either, right?
I mean, everyone.
I went on a train a couple of months ago, and I don't get it.
Especially because if you come from, and I feel terrible because I am sitting in Tom's chair,
Just
so
say it.
I'm going to just say it. But you come from the European train system that's really fast.
Not just it's Asia as well.
Here, and honestly, you go anywhere, they're fast, they're on time, they're clean. Here, they've got delays. They run on the same trains if they're express that the local ones do, which is kind of a problem considering that they're supposed to go faster than the other ones and they're on the same track. But I digress.
I'm an Amtrak guy. I just don't know what to take from that. What does that say about you if you're an Amtrak guy? I just don't get it. You come back from Switzerland and you say I'm a Swiss train guy. I'm like, right, I understand that means something.
I know.
But they're going to put $16 billion with a B into it, Bramo. So good news.
Well,
We'll make it better.
I hope that they do. I hope they build another track so that the Express actually can go express, and that's my dream for this country.
We'll talk about Amtrak, Joe, in just a moment. Let's get to the price action. Equity futures on the S&P 500. Negative here by about 1/3 of 1%. We are pulling back after a 6-day winning streak. You always read the stories, don't you, after you don't get day 7 or day 8. And I sit here and wonder, what are you expecting? This is going to move in a straight line, just carry on gaining. Then you've got to come up with reasons why it's down today. It's down today because Neil Kashkari is not going to declare victory. I mean, come on, stop it.
But this is the reason why this market has been dizzying and very difficult to explain and very difficult to come in every day and address with a new thesis, because that seems to be what's happening. Wait a couple minutes and you'll come up with a new thesis and everybody will jump on board. At a certain point, that's how it's been over the past couple of weeks.
I want to get to a piece from Gallup, well worth a read. 2 major political parties remain unpopular in the United States. 56% of Americans viewing the Republican Party unfavorably. 58% saying the same thing of the Democratic Party. Mohammed Yunus, the editor-in-chief at Gallup, joins us now. Mohammed, help us out. I've been reading through this piece. Neither party is well liked. You guys have pointed out that maybe the GOP has an edge on certain issues. Can we just talk about the likability of both parties right now? Mohammed, how unusual is this?
Unfortunately, it harkens to your Amtrak conversation earlier. We're at a state right now in the United States when both parties are really not doing that great in terms of their favorability. It's nothing new, unfortunately. It's been quite a while since Americans had a favorable view of either party in the majority. We're also at a time where there's a record high of Americans saying that they'd like to see a third party in American politics. Of course, easy to say I want more. It doesn't necessarily mean that that party would exist or actually be powerful. But we're also at a time, John and Lisa, where there's a high of people that identify as independents. And that is important, not only in the current moment, but also in our analysis over generations. What we find is that younger Americans today are actually sticking with that independent ID much further along their lifespan than previous generations' young folks. So certainly America is highly dissatisfied with national government. We've talked about that a lot. They're really, in some ways, most dissatisfied with both parties. That being said, today is a local election. It's really, I know it's so tempting for us to jump to 2024. Americans line up today to vote on local issues. And there's a huge difference in the way people perceive local government versus the national government here in the United States.
So, Mohammed, just explain that a little bit more. What is the big difference between the two currently?
Basically, trust and confidence. Americans have very low trust and confidence in the national government and national institutions. Perceptions of corruption are astronomically high. When you come to local government, though, people have a much more positive perspective on local government, whether it's the efficacy, transparency of local government and corruption, but also how they feel about their local governing officials. So Americans line up in the ballot box today. They're hearing a lot of echo chamber on the national, what this means for 2024. But really, what they're going to be focusing on are local issues. And the national conversation certainly will inform that. That's why things like abortion, things that implicate attitudes about big and small government, for example, they're on the ballot box. They will be discussed. They're going to be, they have been a focus of the campaign. We know in Ohio, there's a really big push on abortion. It'll be a really important weather vane in terms of whether or not Roe v. Wade's overturning has sort of faded, the impact of that has faded, or is still with us.
I have to say, as you're talking about local elections and how different they are than the nationals, I think, well, they're probably not on TikTok, the local elections. They're probably not on Facebook. How much is it the social media echo chamber that polarizes people and gives them a worse than expected view of national politics in a way that local politics might be slightly immune?
I think that's a great point, Lisa. It's much easier to sort of check the BS, if you will, on a topic or an issue when it's about where you live. You know that reality. You have direct information from people you know where you live. You can talk to your neighbors. You can talk to your local religious leaders or community leaders. With national politics, it's a very different thing. It really tends to have now become sort of a war of the propagandas, if you will, of both parties, where truth is very hard to identify, but both sides are absolutely out there to religiously convict you, to religiously convert you to their worldview. So that's certainly a factor. But look, when it comes to 2024, and it's important for us to keep our eye on that, Mark, everything that we've done with regards to national elections really comes down to one thing. Americans focus on the economy. The economy is king. It's not only king, it's king, queen, and bishop when it comes to picking a president here in the United States. And that's going to be a huge factor in where people place their votes in November 2024. But as you all know, we are light years ahead from where that is in terms of assessing where the economy is going to be then. And that's going to be the major factor. When it comes to party advantages, the Republicans definitely have maintained their historic advantage in terms of Americans viewing them as more competent in keeping the country prosperous, keeping the economy booming, and keeping the country safe.
That said, how much are you looking to Glenn Youngkin today? Maybe there is going to be very much local issues that are decided, but the local issues have implications for whether Glenn Youngkin might be the Republican candidate for presidency. Do you think that's a stretch?
I think looking at the polls right now, that is a stretch. It's hard to argue that President Trump is not the front runner of the Republican Party. You know, every poll you do, every poll, what we've done, we don't do too many political polls anymore, but there are good polls out there. It's really hard to see somebody sort of astronomically jump ahead of him. Now, that being said, we haven't had a president in modern time that's facing the legal challenges that he's facing, and that's a whole other sort of curveball that's being thrown here. It's not clear exactly what his situation will be come real kind of rubber meets the road in terms of November 2024. But, you know, we heard from David Axelrod this week about the Democratic side. There's still a lot of movement in this race, and I wouldn't rule out any surprises or sudden departures on either side.
Up against the clock here, just to squeeze this in and finish where we started. You do mention in the piece that the GOP holds advantages on certain issues. Can we just breathe some life into that, Mohammed? Which issues specifically?
There are really three issues in specific. One is keeping the country prosperous. Republicans have a pretty sizable advantage, you know, to Democrats in terms of perceptions of keeping the country prosperous. The other one is keeping the country safe. As you know, we're now very focused on two pretty significant conflicts across the world. Hopefully that doesn't become a reality for us here in the United States. But as Americans focus more on security issues, Republicans do have that advantage in our polls. The final one is who's most competent to handle the most important problem facing the country. And what's fascinating about that question is that the most important problem facing the country, as I have said on this show many times right now, is actually poor leadership and government. So Americans identify the quality, the low quality of national leadership as the most important problem facing the country. So it's the most important problem, the economy, and keeping America safe.
Fascinating. Great to catch up, Mohammed, as always. It's good to see you. Mohammed Yunus of Gallup. Mohammed Alerian writes in, I like Amtrak. Okay, so that's two people.
Yeah.
Okay.
And what did you respond?
I'll tell you my response a little bit later. From New York, this is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Six-day winning streak on the S&P 500, taking a break, a pause, a breather, if you will. Equity futures on the S&P looking like this. On the Nasdaq, negative by 0.25% on the S&P 500 and on the Nasdaq 100 too. What a run we've seen though. 6 days on the S&P, the longest daily winning streak going back to the middle of June on the S&P 500. 7 on the Nasdaq 100. Bramo, that's the longest run on the Nasdaq 100, I believe, going back to January.
And again, this comes on yields going lower, which ostensibly were supposed to benefit the stocks. And then when they went higher, it also benefited the stocks. At a certain point, you start wondering whether they're the havens, as well as the aggressive stocks, as well as everything else, and whether that really is going to be the big performer in perpetuity.
Hardest job at Bloomberg. You know which one it is in Bloomberg News?
Not sure.
The daily market wrap. Because every single day you've got to say why we're up or down. The pressure to do that. That's this part of the game that I have a great amount of sympathy for people who's got to play it. Turn to the bond market. You're right. Yesterday, equities continued the run at the front end of the yield curve on a 2-year yesterday. Double-digit move. Higher, not lower. And yet we just shrugged. We're back in the 490s.
Again, it's sort of how far we've come and how much we've gotten distorted. Well, at least it's not 5%. So if it's 4.61%, it's not a big deal, even if it's up from 4.55%. At this point, I think the question is, how much do we need volatility to come down for benchmark bond yields, for equities to keep going with the rally? Is it that the levels have to keep going down, or is it just stability? Is it just a sense that we're not going to get, the table tennis or the, other things?
Help us define stability. Are we confusing a rally with stability? Because we had a big move out of nowhere in a couple of days, and then you had another big move yesterday. Have we really got stability in the bond market? Yes, we've got yields coming back down from the highs of the last few years, but have we got stability?
If yields go between 4% and 5%, is that considered stability? I think that that's a question, right? If you know that they're going to be trading in a range, albeit a 1% range, is that in and of itself enough to give people the confidence that at least you're not going to the moon, and we're not going to have runaway inflation, and the Fed's not going to hike rates to 7%, right? I mean, basically, if you're counting on that kind of model, ignore the noise, invest long-term, and just basically call it a day.
Let's see how these auctions go. Lisa went through them. $48 billion of 3-year notes. Bramo, $40 billion of 10-year notes tomorrow. Then it's